We're still in a slower growth environment.
I just think that earnings estimates are not really reflecting the fact that we're slowing down as much as we are.
I think tech outperforming, that could be, forward expectations.
Microsoft's magnificently positioned. So is Google. So is Amazon. So is Meta.
Apple, Google, Amazon. I think these are stocks that could be up 15-20% for the rest of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I think it's fair to say the tech bulls are in the driving seat this morning. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures positive 1/3% on the S&P 500, but check out big tech with some big results after the close yesterday evening. Microsoft this morning in the pre-market, Tom, higher by 8%.
It's the way they were higher. It was really, really something. Charles Cantor there in our opening with Neuberger Berman really sounding it up, and he maybe had the best day of anyone yesterday. It was game-changing. You see it within the market today with futures up 12, John, and it really says, what do we do to get through this week and get on to Apple on May 4th after the Fed?
It's a beat on the top and bottom line for Microsoft, Lisa, and then a soothing earnings call from Satya Nadella talking up the generational shift that we're about to see in search.
Well, I love that you say soothing because it's what everybody wanted to hear. This is the new thing. Open artificial intelligence will change your lives. It will make us work less, be more efficient. It will make us rich. It'll be fantastic. And they said this is really going to be a game changer. Google was like, we've seen these things before. Those shares are now up by 1% and Microsoft up by more than 8%. There you go.
Too much happy talk. Too much happy talk. Can we get to the banks? First Republic chopped in half yesterday. That's the reality of the moment, isn't it? You've got this big weighting on the index, big tech, getting it done. And then you've got this worry in the financials captured, Tom, by First Republic.
I was captured yesterday afternoon like I was the day Bear Stearns went under, watching every tick of it slide from 9 down to an 8 level, even a 7 print, a little bit up this morning. I went back and forth on Twitter this morning with Dr. El-Arian, and to me, it is the El-Arian field of game theory right now. And I'm suggesting the institutions, including FDIC, look at this as a discrete bank issue and not something that has contagion to other banks. I'm just guessing that.
The latest
That's speculation.
News, the latest news in the last 24 hours off the back of all of this, and I think there's a lot of speculation out there at the moment, Tom. At least that they could be selling up to $100 billion in assets. This is going to be painful if they go in that direction.
And the bigger question here is this just a First Republic issue and an SVB kind of issue, or is this a broader issue? And we saw PacWest report earnings after the bell that were actually stable. The stabilization narrative comes back. Those shares popping. This is a muddle. It is an economic muddle. And at what point are stock traders saying the economic muddle is Goldilocks?
I'm in silence because we got to wait for the data, including economic data today. The muddle here is less, I think, a muddle, but many different narratives. You can choose your narrative. I mean, that's all there is to it. I guess I'm not surprised by the tech dominance that we saw today and what we're going to see. One thing yesterday, John, that struck me was in all the gloom, including the guidance of UPS, they announced a massive share buyback. And to me, and I'm sure our audience, tweet us in, send us in love notes. If Lisa gets the love notes, I get the hate mail. But within that is the idea of they're hiding how well they're doing.
Yeah.
Guidance is tough. We're going to lay off at 3M, et cetera. But use of cash, there's a real oddity going on here.
Well, tech's not hiding it. We'll get Meta a little bit later. Amazon tomorrow, next week, Apple. You got something to say again?
I think it's really important on a Wednesday here. We got things to look forward to. This morning, Elisa did a great job of this. We got Boeing, we got Norfolk Southern, and then we got Arsenal.
Oh, that's the proper one, yeah.
That's the proper one.
That's the big release a little bit later. Looking forward to that. Let me get you up to speed on the price action. Your equity market looks like this on the S&P 500. A lift by 1/3%. A much bigger lift on the Nasdaq off the back of those big tech results after the close yesterday. In the bond market, 340 on a 10-year, on a 2-year, a break of 4% yesterday. Significant stuff off the back of weaker economic data from the regional Fed indicators. And Lisa, I don't think I've ever seen money supplies discussed so much like it was yesterday. I think that's the first time in a long, long time we've talked so much about M2 back on the agenda?
Well, this is the interesting thing. Amid all of the optimism in tech, you're seeing real pessimism in the underlying economy, whether it's consumer confidence, whether it's the regional Fed surveys, or whether it's this idea that the tightening is taking hold. And that's the reason why I think that today, the sense of business investment that we get from U.S. wholesale inventories and durable goods for the month of March that is due at 8:30 a.m. will be interesting. It could feed into this discussion because here we are talking about American resilience, corporations still making money, doing well, and people are pricing out rate cuts, pricing out rate hikes, and pricing in more rate cuts by the Federal Reserve. So what gives? Is this really an economy where companies can pass along price increases to consumers that are endlessly strong? Or is this an economy in decline? Today, we do get Meta reporting after the bell. Those shares up more than 70% year to date. Can they come through with the same kind of optimism that we saw from Microsoft, boosted by OpenAI, and Google? Is ad spending still remaining resilient at a kind of motley time? And today, the other interesting earnings, Tom, as you mentioned, Norfolk Southern to report at 8 a.m. We'll be talking about what happened with the fallout from the derailment in East Palestine in Ohio, as well as Roku and Mattel. Some of the specific stories are really interesting. With Norfolk Southern, regulation is one of the keys here. How much more is there going to be?
It's going to be interesting to see. And, of course, the separation of each company with their forward guidance. I'm looking for forward guidance from Arsenal at 3 p.m.
I'm watching the same thing. I can't wait for that game. I can't wait for that game.
Come on, it's the game of the year.
If I'm not good on Meta tomorrow morning, you know why. I was distracted when those earnings came out. Joining us now, Max Kettner, Chief Multi-Asset Strategist over at HSBC. Max, you've been bullish. I'm reading through your notes. Not enough right now to turn defensive. In fact, you say the next positive catalyst is about to hit us. Max, what is it?
I think it's partly the earnings season, right? What we've seen yesterday, that sort of confirms that earnings are not as bad as feared. That's good, right? And what I've taken away from you guys now in sort of the introductory remarks is the muddle, right? Muddling through. And quite frankly, I love this muddle right now. It's the best thing that can possibly happen to us right now. Because quite frankly, if we got things too good, then, what Lisa was just saying, well, we're probably going to then price out the rate cuts, and we're actually going to price in more rate hikes again, right? The rates vol is going to pick up again. So we don't want things to be too good. And likewise, we don't want things to be sort of falling off the cliff. So it's actually really good to have a couple of things surprising to the upside, a couple of other indicators surprising to the downside. That's great. That's absolutely great from a risk asset perspective. It means lower vol, it means lower rates vol, and it means that actually we can get going on risk assets a bit higher.
Max, in the equity markets, can you have a bull market or can you have a constructive market if a certain percentage of the stocks don't participate?
Well, I do think so, particularly, when you look at the last couple of years, what that's done to market capitalizations, what's that done to market concentration, and that obviously hasn't changed, right? That's not been sort of put to its head yet. So we do see that some of those names, let's say like yesterday, that have reported have such an outsized weight that perhaps something like First Republic like yesterday, that doesn't carry the weight as much. And I would say also the same applies to Europe, right? We have in Europe a bit of that sort of China reopening trade and the proxy trade with China reopening, better consumer spending, that's coming through. And then we've got on top of that also really the realization that European growth, both in the UK and in the Eurozone, is not as bad as feared. It's not great. It's not rock and roll, but it's absolutely not as horrible as people have feared perhaps 4-6 months ago.
Max, how long can economic muddle be Goldilocks?
Yeah, I think it's probably going to go towards the summer. So our timeline is really towards the summer, beginning of the second half, the next sort of 3-4 months still, because the problem then will be that we will have much higher earnings expectations, also much higher top-down growth expectations. And bear in mind, right, the narrative for 2023, just a couple of months ago, was the first half is going to be bad, then the Fed's going to pivot, then you get a recovery in the second half. So that means the bar to beat on the earnings side and the top-down side in the second half is going to be much, much higher. On our estimate, our forecast, headline inflation in the US is also going to re-accelerate towards 4.5% by the end of the year. And we still have a bit more than 2 rate cuts by the Fed being priced in. And that sort of bites each other, right? That cannot happen in combination. One of those will be wrong. So our timeline is really towards sort of the next 3-4 months, towards the summer really becoming a little more defensive and a little less constructive.
Forgive me just for focusing on one thing, but next week, the Fed coming into view. Max, where does that leave the Fed decision next week?
I think it's basically more of the same, right? If I was the Fed, I would be as boring as possible, right? I'd basically say, you know what, 25 bips will not give you as much guidance, right, as you possibly think. So we're not gonna be concrete on this is definitely gonna be the last, or there will definitely be another one. I'd be basically reiterating, okay, you know what, we're still data dependent. There might be better labor market data, or there might not be, opening the door for it to be the last, or opening the door or leaving the door open for another 25 basis point one. I think, as long as they do that, I think it's going to be a pretty non-event.
Max Kettner stays bullish, Chief Multi-Asset Strategist over at HSBC. Max, thank you, sir. Steve Englander over at Standard Chartered put out this note overnight. A dovish hike in May would ease financial conditions. A hawkish hike could destabilise things. He goes on to say a hawkish pause leaves the most room to follow the data. It sounds like a bedtime story for kids, doesn't it?
Hawkish pause?
A hawkish pause.
I think it's banned.
A dovish hike in May
Neil Young like nobody.
would ease financial conditions.
They really had a tone
hike.
like Crazy Horse.
Not too hot, not too cold, Tom.
Yeah,
just right.
Yeah, hawkish pauses,
Yeah, get it done.
They're good. They played Talagis in Boulder every Tuesday afternoon.
There was something in that note, though, that was really interesting that he highlighted, which was core CPI ex-shelter has gone back to the range that it was in from 2000 to 2019. Underpinning the divergence in views is where are we in the fight on inflation? And I think in the earnings reports, you also see, really motley picture with some companies able to raise prices more than their fundamental costs and others not so much.
Yeah, but you bring up a really important point. We've sort of lost in all the news flow and narratives that we're talking about the inflation watch. And the answer is, if you throw on a 4% inflation watch and you don't believe in Michael Darda's 2% inflation, but if it's 4% plus whatever GDP is, you get revenues still are pretty good, and maybe you get another good quarter of earnings that nobody's expecting.
Or just to build on what Lisa talked about, let's sum it all up. Procter & Gamble, Kimberly-Clark, was it Pepsi this week, Coke this week, same thing,
10% increases.
Double-digit increases across the board, and the consumer doesn't seem to be pushing back.
Not at all. In fact, that didn't bother their bottom lines, their revenues. What I love is also Chipotle. They beat earnings in part because avocado prices went down. So you see these sort of specific...
You put out an informed tweet on that. Did you write that tweet from Chipotle?
I just think it's just these little moments with the volatility and inflation, an opportunity for some of these companies to cash in.
She goes for the burrito bowl. She stays for the margaritas.
You don't strike me as a Chipotle guy.
Yeah, they don't sell margaritas.
At all. There's a man who's never been in.
Exactly.
Right? They should sell margaritas.
100%. There's
a man who's never been to Chipotle. Yesterday, First Republic cut in half. This morning, struggling to bounce. Up next, Christopher Marinac of Jenny Montgomery Scott on a beleaguered bank in the United States.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy is moving ahead with a vote this week on his bill, linking a debt ceiling increase to spending cuts. Still, the measure is in danger of being sunk by McCarthy's fellow Republicans. GOP lawmakers from Midwestern states have raised concerns about provisions that roll back biofuel-related tax credits and subsidies. The Pentagon is learning some valuable lessons from Russia's invasion of Ukraine. According to Deputy Defense Secretary Kathleen Hicks, those lessons could come in handy in case of a conflict with China. Hicks says the U.S. needs to build a steady ammunition pipeline and continue to innovate in space. High-frequency indicators in China show that the economy kept expanding this month. Still, the strength of the recovery is under scrutiny because of unemployment and uncertain global environment. Bloomberg's index of 8 early indicators rose in April, and that was largely due to a jump in car and home sales from a year earlier. Shares of Microsoft are higher after the company posted quarterly profit and sales that were better than expected. Corporate cloud computing demand was resilient, plus the company gave an upbeat forecast for its growing artificial intelligence services. Microsoft will step up spending to meet customer demand for new AI tools. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We need to have clear standards that apply, that are transparent, and I'm really concerned about the fallout. In particular, I'm concerned that we're seeing a flight of capital away from community banks, away from mid-sized banks to the giant banks.
In many ways, that's precisely what we're seeing. Just a fantastic exchange yesterday, a conversation between the Republican Senator Ted Cruz and our colleagues Anne-Marie and Joe Matthew on balance of power yesterday evening. If you want to watch that in full, you can do on Bloomberg.com and on the Bloomberg terminal. If you're just tuning in, welcome to the programme. We've got a lot to get up to speed on, including the price action right now with your equity market just about positive on the S&P 500. But that masks some big moves elsewhere in big tech. Microsoft absolutely flying. A beat on the top and bottom line from Microsoft and a strong guide about what's to come around AI, enough to boost this name by almost 8% in the pre-market. Wow. That's the good stuff. Let's get to the bad stuff. This name right here, First Republic, cut in half in yesterday's session. It is now positive by just 3.8% this morning. It's a single dollar stock, Tom, $8, a single digit name now, $8.41. From Jenny Montgomery Scott yesterday. Listen to this for the title of a note. FRC needs to pull off the mother of all pivots to survive.
Yeah, there's no question about that. And what's important here, and really the reporting led yesterday by Gillian Tan and Matthew Monks at Bloomberg here on what needs to be done at FRC. Christopher Marinac has not been a stranger. We really thank him for his participation, seems like day after day. Director of Research, Jenny Montgomery Scott. Christopher, what was out there yesterday, article to article, research note to research note, was a guesstimate of the haircut needed. Let's review. They have garbage loans, jumbo mortgages taken out at 2%, whatever. You can do the math. Is there a way for you to ascertain the required haircut for their management to find stability?
I think there is. I mean, they have a lot of government securities and loans that are simply underwater because of interest rate. It's important that it's not a credit issue. It's more interest rates. And they've got fixed rate mortgages that were done at 3.5%, and the world's easily 2 points higher, if not 3. So that is the reason for the haircut. And of course, it's the uncertainty about the ability to raise capital. That's always where the challenge is for these banks, going back many, many years and cycles. So I think that the lack of knowledge and, of course, the lack of questions Monday night didn't help matters. And so here we are. I think that the company needs a solution. There's 3 ways out of this. They can raise capital, they can sell, or they can fail.
Well, what's interesting here, Christopher, is the optionality this morning for Secretary Yellen and other government institutions. Do you suggest it'll be a clean haircut with or without government intrusion, or will they be able to negotiate some form of more full balance sheet takeout that includes some form of equity option?
So the Treasury has a program in place for community development banks, CDFIs, where the Treasury actually invested preferred last year at a 0% rate for 2 years, and then it was 2% after that. They would have to make a special dispensation to make First Republic a CDFI, but it's not a crazy solution. It would actually give them capital from the government, a la TARP, like we did in 2008. But that would be a one-company solution. I'm not necessarily sure they're going to do that, but it is an option that our secretary has at her disposal if she wishes to.
Chris, you said 3 options: raise capital, sell assets, or fail. Let's assume, for good reason, they don't want option 3. Can you tell me what option 1 actually looks like? What would that look like, raising capital?
Sure. So they would have to do a combination of, I think, equity and preferred. Equity is the best alternative. It would most likely be done, of course, below last night's price, but maybe not necessarily a lot below. It would allow the tangible capital to recover, take losses, move down the road, live to fight another day. I think the question is, will the company dilute their shareholders, existing shareholders, by such a massive amount? I mean, we saw this happen in 2008, 9, and 10, so it's not the first time we've been through this exercise. But I think it's a question of whether the board and the management team are willing to dilute their existing team. I think they're going to have to, unless they can find a bid that's more reasonable.
Christopher, we're talking about this particular company, which we're now debating whether it's idiosyncratic or whether it's representative of perhaps larger ills in the regional banking sector, albeit a more concentrated version of it. How do you look at this in terms of what it exposed about the broader sector?
So overall, credit quality is still really good. Banks give out way better information today than they did 15 years ago. So if we looked at substandard rated credits, special mention rated credits, anything that's not a pass, you typically have 2 to 2.5% today that's problematic at a bank. That's a long way away from where we were at 8, 9, 10% back in the great financial crisis. So we have a long way to go for credit quality to match the last cycle. So I feel like the credit's not the issue. This is an interest rate risk problem. And of course, many banks have held to maturity securities, available for sale securities that are below water. And even though rates are down, they're still below water easily 10 to 12%. So we have to either raise capital to create confidence around those losses, or we simply have to wait. In the case of First Republic, it's impossible to wait. They need a solution, and they need one very quickly.
We also have to think about what the implication is for lending and just loan creation. UBS analysts put this out. They say that bank, commercial, and industrial loan growth looks to drop about 5% in the last 3 months of the year, and then 10% in the first quarter of 2024, which is associated with recession-like conditions. Do you agree? Are you starting to see that type of necessary response to the lack of deposits, to the concern around the balance sheet?
So I would disagree with the percentage change. I think that the tightening is clearly on. Banks are going to be very careful about the standards that they make and the way that they allocate credit. However, the flip side is going to be that they're going to charge a lot more for that. And I think the earning asset repricing in the banks is actually better than folks realize, which could actually be a positive for net interest margins beyond this quarter. This quarter will be a challenge, but I think in third and fourth quarter, we could see not only stabilization, but actually increases in margins.
Chris, I get that this was only really kicked off in the middle of March 8th with SVB, but we've understood the rate story for a long time now. It's a pretty aggressive hiking cycle last year. I'm already getting messages from people saying, what took so long to consider asset sales this large? What have management been doing?
You're right.
Well, it's a great point. I think that a lot of companies thought that they could simply use their liquidity from the home loan banks and other sources to work through the issue. And I think that was a false narrative for sure. I think the reality is if banks would have been more likely to hold money at the Fed all along instead of buying treasuries, it would have been an easier solution. They wouldn't have had the mark-to-market issue. I think the mark-to-market accounting is what has been harmful here, no different than 2008 and 9. But it is what it is. We have to account for this every quarter. And of course, I think the lack of understanding about when banks would see either sales of their securities or simply just the natural amortization, I think has been one of the challenges. We're getting better transparency, but I still think the issue is to raise incremental capital to create confidence around the issues that we still have these mark-to-market securities.
Hey, Chris, just wonderful to get continued input from you on this story as it evolves. Thanks for being with us. Christopher Marinac of Janney Montgomery Scott on the latest from First Republic with just a stunning note just yesterday, Tom, with the headline of it reading, FRC needs to pull off the mother of all pivots to survive. And Chris basically offering 3 options: raise capital, sell assets, or fail, and they're certainly going to try a combination, Tom, one or the other.
Yeah, I like how you had that one, and you're looking at item number 1, and that's maybe a static analysis wrapped around management. I think Lisa absolutely nailed the dynamic nature of what we're seeing with the banks, and I'd go with a lending slowdown, Michael Darda alluding to this in a phenomenal overnight note. But there's another one here, John, nobody's talking about. The revenue producers are walking out the door. And this is, I can't say enough, how 20% of the revenue producers produce 80% of the profit, and that means 80% of the profit margin dynamic is moving out the door right now. I don't want to mention the names because I don't have them in front of me, but to all the other firms we talk to each and every day.
Well, we can talk about a name that's failed. Similar story to Credit Suisse, Lisa, in the last year.
And that's really the key issue that they talk about with UBS integration. How concerned are they about retaining the talent?
Looking ahead to the Federal Reserve next week and the data we've had so far this week. Francis Donald of Manulife Investment Management coming up. Your equity market just about positive on the S&P, positive 0.26%. Equity markets positive this morning. Let's wrap up the price action for you on the S&P 500, positive 1/3%. But here's the boom. The Nasdaq 100, positive 1.2% this morning. A lift given to it by Microsoft, up by almost 8% in the pre-market. Their stock is flying. A beat on the top and bottom line from Microsoft, some encouraging words about the cloud, and of course the future of artificial intelligence and what it means for search, Tom. A lift for that name and others too this morning. Amazon off the back of that positive. Looking ahead to earnings from Meta later, Amazon tomorrow.
And the Dow Jones component, First Republic Bank, has a nice lift up to 850-ish, and just moments ago begins to roll over. It'll be very careful here to see with an 832 on First Republic. For those of you bored by this, I'm sorry. It matters to global Wall Street. We're going to be following near every tick of First Republic this morning.
First Republic still trading with an 8 handle in the pre-market, cut in half in yesterday's session to around about 8 this morning, positive by 2.7%. That's the price action at the single name level. Here's the bond market for you. Last week, Monday through Friday, 2-year north of 4%. Yesterday, a break of that level, 392, down 3 basis points on a session again, dragged lower by these regional Fed indicators suggesting some disappointing economic numbers might be in our future, off the back also of this big talk about money supply contracting at the fastest rate in who knows how long, and we can talk about that in just a moment. I want to finish on this in foreign exchange. Keep an eye out on a certain level. Euro-dollar, middle of this month, middle of April. The euro against the dollar, 110.76. We're back to 110.50. We're positive 0.7%. Strong euro story in the mix this morning, TK. That's one to watch.
Yeah, it's one to watch. I'm going to go to euro yen. I thought Jens Nordvig and Steve Englander yesterday were just really outstanding on this. And there's a debate out there. Jordan Astevilla, I mean, he's looking for stronger euro.
You wanted to mention Villa. Villa's doing better than good.
I watched the highlights. It was good.
You know, I got a lot of messages yesterday that still want your review of the Spurs game over the weekend.
My review is, and I don't know if you saw this, John, but, you know, they've come out, they blew up the coaching staff, and then they came out with they're putting up a fan appreciation committee.
They're refunding the fans.
I literally had...
Have you ever seen anything like that? They're refunding the fans.
I almost spit the olive out on that last sip of my martini.
They're giving the money back to the fans because the game was that bad.
That was the players. The players are doing that. I didn't read that, but yeah.
Amazing.
Yeah.
Amazing.
Never seen it, Lisa.
Yep. I don't want to go back to the dollar, but I just wanted to say one thing about that was interesting. Stan Druckenmiller, did you see the comments that he had?
I missed that.
Where basically his one top conviction trade was short the dollar. And it was because of policy missteps. It was because of policy missteps both by the Federal Reserve as well as a potential debt ceiling debate. I mean, it was all around the most bearish thing I've ever read in terms of his view, but really telling at a time where he didn't have much other conviction.
Well, absolute legend of the FX market, going back to the story with Soros, which we've talked about many, many times. Can I discuss the other half of the Druckenmiller view that was in the Financial Times? The trade he missed, maybe the biggest miss of his career, one of, suggested by Druckenmiller, going long the US dollar last year. And the way he explained it, I thought was really interesting, that he didn't have much faith in this administration or this Federal Reserve. And ultimately, that was a reason why he didn't want to get long the US dollar. And there was a trade, obviously, that fell apart at the end of September, but we saw some major, major moves off the back of a much stronger dollar, weaker euro, weaker pound, and that's turned around over the last few months. On the outlook for the US economy, Francis Donald of Manulife has this to say: "It's fairly clear to me that we're headed for a material slowdown or recession. And if we are in a normal environment, I'd be preparing our investment teams to consider when it will be a good time to jump back into risk. But this isn't a normal environment. It is still a COVID-distorted economic cycle." Tom, I know you love that line. And thus we have two flies in our model ointment. Thank you, TK. 2 flies in our model ointment.
Francis Donald joins us right now. This is an important brief, really good at the minutia that adds up to our gross domestic product. Francis, if we don't get a recession, but we get sort of kind of like a muddle, 1.5%, 1.1%, 0.7% GDP, not under zero, what does that feel like?
Well, it depends how the central banks respond to it. But, Tom, I'm more concerned about that very slow but persistent weakness than I am about a garden variety recession. We know what to do in garden variety recessions, and we know that central banks historically pivot. But what we're witnessing is, yes, a COVID distorted economy where we're seeing desynchronized elements. We're seeing a consumer that hung on much longer than they would have in other cycles. Housing is already starting to reaccelerate. I'm not sure we're going to get the same sort of response in things like GDP data to the traditional shocks that we've seen. 2019. And therefore, the risk is that we continue to hear, well, there's no recession,
Right.
and therefore you can go long. But if the Fed says, well, no recession means we hold, that's a very different investment playbook.
Francis, you got a colored dot chart. It looks like the new Louis Vuitton purses that everybody's buying right now. Don't ask me, folks, while I know about that. But the chart you mentioned is one of your great concerns, is what Lisa mentioned earlier, which is M2 growth. I'm surprised that Francis Donald is going monetarist on us. Discuss that.
Well, actually, I'm not just a monetarist. We look at all elements that potentially lead to economies doing poorly. And that's the problem here, Tom, is that no matter what way you assess where growth is going, basically every traditional leading indicator of recessions is flashing red. And some of these are flashing red, not consistent with garden variety or small recessions, but some of the big problems that we had, like in 2008. Now, is that necessarily where you're going? No, but what I say to my team is, even if we cut in half our concern about downsides in growth, we're still looking at a very difficult economic environment. And to ignore the breadth of the challenges that exist and the breadth of the weakness we see in leading indicators, I think is going to be problematic.
And what's interesting here, Lisa, is Liz Ann Saunders really underscoring this out on Twitter yesterday, where you were on M2 growth.
Well, and John was mentioning earlier as well, this idea of what happens when suddenly the restriction by central banks starts to play out in markets. Francis, you say that an economic muddle might not be so great. It's very difficult to read because we don't understand what the different inputs are and where we are in the economic cycle. But if you just take it at face value, why isn't it the Max Kettner view of things, where basically if it's not too hot, not too cold, the Fed's kind of stuck in the middle and things can grind forward at least for a few more months?
Because we're at extremely high levels of interest rates for this level of the economy, and we're heading towards a sizable credit crunch. And this is why data like the senior loan officer survey that we should be getting by May 8th is going to be just so incredibly important. Because even if GDP numbers are not negative, this is still an economy that's going to struggle to produce revenue. It's going to struggle to produce jobs. We're going to have to move away, just like we've moved away from the concept of the unemployment rate, giving us a good sense of the health of the labor market. We're going to have to move away from GDP as giving us a good sense of general economic activity that exists. And if the Federal Reserve is still going to be focused on these traditional indicators like GDP and unemployment and even the PCE inflation rate, then we're not going to get relief from them. And this is a market that has already priced in some relief. So the problem with slow growth that isn't a full-blown recession is that we likely don't get relief on the rate size. And this is going to produce a challenging risk environment.
So, Francis, when you start talking about some of the challenge profits and things at corporations, this has been one of the most surprising aspects of this earnings season. I was looking yesterday at Procter & Gamble, at Kimberly-Clark, and their profit margins expanded. They were able to raise prices on consumers more than their underlying inflationary inputs. What does this say about just how much weakness or not there is, how much tolerance there still is in consumers to absorb all of those price increases?
Well, it speaks to the desynchronized nature of this environment. But as we move forward and we see credit pull back even more sharply, and we see some of the challenges that flow through primarily to small businesses. I mean, let's remember that small businesses are heavily credit dependent, and they've created the majority of jobs since 2020. So as companies start to feel the pinch through the credit channels, they're going to have to be cutting costs in some way. And I think that's going to flow through into the labor market. So again, we have a consumer that held on longer than it would have historically, but all evidence suggests excess savings are coming down. Credit is not going to be available. And as you know, Lisa, there are already some signs that the labor market is going to weaken. So right now, there's some ability to absorb those price increases, but 6 months from now, not so much. And this is when the story is going to change. And it comes back to our job is not to tell us what's happening right now. Right now, we're okay. It's to look forward 6 months. This is why it's so key to disaggregate between coincident indicators, leading indicators, and lagging indicators. And when you do that, sure, coincident data is just fine, but the leading indicators is where the challenge is, and confusing those two, I think, muddles the story.
Francis, the Bank of England has a message for us all. We need to accept that we're poorer, apparently, in one of the most insensitive remarks we've seen from a central banker since Governor Bailey told us all to stop asking for a pay rise. This is what Hugh Bill has got to say. What we're facing now is the reluctance to accept that, yes, we're all worse off, and we all have to take our share, to try and pass that cost on to one of our compatriots and say, we'll be all right. but they will have to take our share too. This is bizarre. He's effectively saying, Francis, we need to accept that inflation is high and that wage growth won't be enough, and we shouldn't push for higher wages. Francis, what do you make of those comments from Hugh Pill of the Bank of England?
Well, it's concerning in the sense that we know the bulk of these challenges have hit low-income households across the world who've seen their share of spending on food and energy rise. I do interviews where the person prior to me is talking about, record lines in food banks. So telling somebody that is struggling to put food on the table that they have to accept higher inflation is going to go down a little bit more problematically. However, the bigger investment concern here is that, again, we are used to in an environment where central banks provide relief, a central bank put. And comments like this keep me up at night because they say, some of the difficulty we're seeing in, banks, some of the difficulty we're seeing for households is a feature, not a bug of current central bank policy. And it suggests we have to reassess that decision-making function for all central banks globally. And if we do that, we may not be getting the standard relief rally that comes when you see lower growth. It's effectively a stagflation response function, and it is much more challenging for almost all asset classes than a two-quarter dip, a Fed cut or a Bank of England cut, and a reacceleration. I'm not sure the market has fully grasped on to the risk of a recession with no rate cuts. Comments like this worsen my concern.
Francis, thank you. Francis Donald of Manulife Investment Management. That line from Hugh Pill of the Bank of England, the chief economist. There is a reluctance to accept that, yes, we're all worse off. Bramo, is that something we need to accept?
Let them eat cake. I mean, this is his Marie Antoinette moment. Honestly, this is basically going to be railed against exactly for what Francis Donald just said.
It's another embarrassing moment for the Bank of England. If there was a moment not to talk or do interviews, I think when you've got thoughts like those,
100%,
maybe that's a moment not to talk or do interviews.
He's still declaring victory. Remember that headline? We're declaring victory.
On what?
Okay, exactly.
Oh my goodness.
I'm not making jokes about it. England to me is way worse than what's going on in the United States right now. It's scary.
Well, we can have a conversation about
scary
that, Tom.
Stuff.
In your equity market, positive 0.2%. The euro stronger this morning for sure. The euro against the dollar, 110.53.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Speaker Kevin McCarthy is confident his bill linking a debt ceiling increase to spending cuts will pass on the House floor this week. This despite divisions within his own Republican Party that threatened to vote against his proposal. Some don't agree with the measure's ethanol tax breaks and work requirements for Medicaid recipients. The U.S. will gradually lift sanctions on Venezuela if the country moves toward restoring fair elections. That's according to the Deputy National Security Advisor, John Feiner. He spoke in Colombia, where there's a summit aimed at restarting negotiations between the Venezuelan government of Nicolas Maduro and the opposition. Shares of Google parent Alphabet are higher after the company reported first quarter results that beat estimates. Alphabet's cloud unit turned a profit for the first time. Meanwhile, its dominant search business weathered the economic downturn. U.S. companies in China are growing more pessimistic about the relationship between the two countries. According to a survey from the American Chamber of Commerce in China, 87% of those responding are negative about U.S.-China ties. That's 14 percentage points higher than the previous survey. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Microsoft magnificently positioned. So is Google. So is Amazon. So is Meta. These folks own the largest computers in the world, and they're going to rent them out to everyone else, and everyone else is going to enjoy a 500 basis point margin improvement over time. And that's going to be very good for the economy.
Charles Cantor was just absolutely brilliant in yesterday's conversation. Charles Cantor of Neuberger Berman and some of the big tech names. The enthusiasm for the likes of Microsoft reflected in the moves we're seeing this morning. On Microsoft, positive by close to 8%. Equity futures get a lift as well on the S&P, on the NASDAQ. The NASDAQ absolutely flying this morning off the back of these numbers from Microsoft. The NASDAQ up by more than 1%. The S&P 500, futures positive about 0.25%. The name I want to sit on just for a moment, though, before we go forward and talk about tech. We've just rolled over on First Republic in the pre-market, so we're negative on the session.
Rollover.
It's a break of 8. So it's a break of 8. We're now trading in the 7s on First Republic after this stock, Tom, got chopped in half yesterday, and all the talk this morning. The follow-through from yesterday, really, asset sales up to maybe $100 billion worth. We spoke to Jenny Montgomery Scott moments ago, who have got basically summed it up as follows in their research. They need to pull off the mother of all pivots to survive. That pivot is either going to be a combination of asset sales, Tom, and a capital raise somehow.
They're going to have to see. Our Shonali Basak here with our team. Our team is up in San Francisco working on this, and, of course, over to Washington as well. John, do you think Washington gets involved in this discussion today? I would guess they do. Right now, a new low, John, 7.75.
Well, things moved pretty quickly with SVB, didn't they?
Yeah.
It moved pretty fast. This has moved really, really quickly. It's only still April, and this already got going.
It's a British phrase, OBE, overcome by events.
Big time. Big time.
There it is as well. Let's move on here right now. And what we're going to do here is, off of Charles Cantor's wonderful comments, talk about your reassessment on big tech. Timothy Horn is senior analyst at Oppenheimer and joins us this morning with a real gift here on Microsoft as well. Tim, let's go back to the time of Rick Sherland and an old Microsoft of old. Let's begin with the new Microsoft. How is this Microsoft different than the Microsoft Rick Sherland covered years ago at Goldman Sachs? How's the new Microsoft different than our stereotype?
Well, for one, it's not a monopoly anymore, so they've learned how to compete and create new products, and they've totally positioned to the cloud, where they were really far behind Amazon, and as a result, they've had to be, I think, a lot more innovative. So you've seen them take the lead on AI, and they kind of optimize their infrastructure, their whole business model right now around AI, which is very different.
What is their use of cash picture? We saw a share buyback from Google that was stunning. We see it, frankly, from others outside the sector. But do you look forward here with this good news, with margin resiliency, with the defensiveness, a constructive tone? Do you look for a new use of cash in share buyback and dividend?
They're going to be pretty steady. They have a steady dividend, that's going to grow in line with earnings. Steady buybacks going to grow in line with earnings. They did say they're going to spend a lot more money on CapEx, for AI. These new NVIDIA chips are very expensive, and they're buying an awful lot of them.
Do you buy the promise of OpenAI, Tim?
Totally, completely and totally, I buy into it. I think it's going to be the most profound thing we've seen in 10, maybe 20 years or longer. I kind of think back when I first got on the internet 30 years ago, how much of a revelation that was and how much it changed my life. And I think we're going to look at the same thing.
So then, if that's the case, is it a real liability for Alphabet that they kind of downplayed it, perhaps to get a competitive edge with respect to Microsoft, perhaps to downplay fears that they're going to lose some sort of preeminence with their Google search engine to Microsoft? But do you think that they're going to be left behind because they're not emphasizing it to the same degree?
It's going to be the critical 6-9 months ahead of us because OpenAI gets better and better the more people they have using it. But we know that Google and Amazon are throwing billions of dollars at AI. We know they have very, very good large language models. The key is they got to get them rolled out and get people using them, or else Microsoft will once again become the operating system like they did with the PC for one of the most important technologies for the next 20 years.
I understand the promise of this purely from a technological point of view and the promise in terms of efficiency as well as productivity, Tim. But what is the time frame for this being actually profitable for the likes of Microsoft?
For OpenAI, for them, they have a product called GitHub Copilot, which is helping people write software, and it's improved the amount of software any programmer can write by 50%. They charge $10 a month for that, and they have 10,000 companies using that product. They're going to charge similar kind of add-on for Office 365, and that will probably be in the next 6 to 12 months. They'll start really adding on prices on these different applications. But importantly, they're just bundling together a whole set of new products. They're getting a whole set of new customers they never would have gotten before. New startups would have gone to Amazon. Now they're going to Microsoft.
Tim, you've been doing this for ages. Can you extrapolate what you witnessed yesterday with Microsoft up pre-market 7, maybe even 8%? Can you extrapolate that over to all the other techs, over to Apple, over to NVIDIA, over to Broadcom, et cetera?
That's a great question. I think Microsoft's gaining share. So it's going to be a little difficult. I mean, Amazon's quarter is going to be very important, but I think this is company by company. Talking to them after the call, they're not trying to say they're a leading indicator on macro. They don't really know where macro's going. It probably is slowing down. If you listen to Mr. Druckenmiller, he's calling, as you were referencing before, for a hard landing. But they think they're gaining share on like 6 or 7 different products, and they're probably right. So I'm not entirely, sure what it means for the whole tech sector at this point.
Tim, as you talk about this arms race in artificial intelligence, where are the ethical concerns, especially as a lot of tech giants have been talking about perhaps pumping the brakes a little bit and understanding it a little bit better before it gets rolled out in some sort of mass?
It's a great question. I'm no expert on it, but, automobiles kill a lot of people. Firearms kill a lot of people, go on and on. A lot of medicine kills a lot of people. It doesn't mean that we kind of stop developing medicines. And I think the genie's out of the box here in AI. We're moving forward. Whatever happens, we're just going to need some regulatory, I think, guardrails around it.
Hey, Tim, thanks for the latest on Microsoft. That stock is up by close to 8%. That's the name we'll be focused on going into the opening bell. Here's another one. Breaking down still on First Republic in the pre-market. Yeah. FRC down to about 750-ish. We're down about 6%, Tom, on the session.
We try to avoid here. It's the heritage of Bloomberg surveillance, inflammatory words. John, this is a plunge. Now a new low. There is no bid.
Well, just to be clear, yesterday was a plunge. I think we've had to redefine what a plunge is for this name. Got cut in half. Down at the close, Lisa, by close to 50%.
And now people are parsing through whether this is very specific or whether this is something broader for the regionals. Tony Dwyer and Tom, just give me 1 second. Tony Dwyer coming out and saying that his view remains the same, that this highlights some of the concerns, the broader concerns in the bank industry that does affect their belief in recession. And we saw that yesterday. First Republic, the small bank, dragged the entire market down.
May I suggest, without any news knowledge, that just perhaps we see government announcements before the market open on this?
No idea. No idea.
Why?
You can speculate.
Well,
you can speculate.
Are we going to enjoy this at $6?
I don't think anyone's enjoying it, that's for sure. So I'll give you some good news. If you look at KRE, the regional banking ETF, which is followed by a lot of people, you can get a pre-market view of KRE, and it's still positive by 0.5%. So the more this is isolated, the more confidence, more comfort that I think we can take away from this situation. And that's the thing that a lot of people are going to be focused on. Does it lead to difficulties elsewhere? Will it be isolated to this name? Certainly this name, Tom, still falling, down a little more than 8%. Meanwhile, elsewhere, Lisa, you are still seeing things just about hold up.
And that's because of this sort of muddle through that you're seeing with some beats and some misses. And how much is tech really supporting that, as we were just talking about?
Oh, tech in a major way. So Meta later, onto Amazon tomorrow. Amazon with a stealth rally year to date of something like 20% higher and hardly been talked about. We talked about Meta.
I agree.
Because it's up by more than 70%.
Yes.
Been talking about Microsoft, Google because of AI and this battle, this tug of war between the two names. Amazon just quietly under the radar, putting in a gain of 20% year to date.
In the zeitgeist, I'm sorry, I can't cite the source, thoughts of Amazon having announcements this Wednesday on expense control, job reductions, moving further away from that COVID overhire.
Looking forward to catching up with Brent Thill a little bit later on some of these themes. Laurie Heinel's going to join us shortly of State Street Global Advisors. We'll talk about the banking situation, what it means for credit creation. Do we get a credit crunch later this year? And ultimately where it leaves the Federal Reserve. The Federal Reserve facing some weaker data through the week so far, which has really started to drag down yields in a material way. We've gone from north of 4% on a 2-year back to south of 4% on a 2-year. Later on Bloomberg TV, Rick Reeder of BlackRock in the 9 o'clock hour, Bob Michael of JP Morgan Asset Management. Bob Michael looking for 3% right the way through the curve, from the 2-year all the way out to the 30-year maturity.
3.00?
3.00.
Wow.
Right the way through the curve. We'll have that conversation a little bit later. Your equity market just about holding up but fading on the S&P 500 as First Republic struggles to bounce. That stock is down 8%.
We're still in a slower growth environment.
I just think that earnings estimates are not really reflecting the fact that we're slowing down as much as we are.
I think tech outperforming, that could be, forward expectations.
Microsoft's magnificently positioned. So is Google. So is Amazon. So is Meta.
Apple, Google, Amazon. I think these are stocks that could be up 15-20% for the rest of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Two stories this morning, one good, one better than good, the other ugly. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market just about holding up on the S&P 500. First Republic, anything but holding up. That stock is down by more than 10% in the pre-market, just about holding on to a 7 handle on First Republic. That's the ugly news. Here's the better than good. Microsoft in the pre-market higher by close to 8%. Earnings from that name, tremendous. The guidance around AI, encouraging for the equity market bulls, for this single name at least. That's what they wanted to hear. But Tom, we've got to kick it off with FRC. FRC facing a pretty important moment this morning.
I agree. It's more important than big tech, and big tech, of course, rolls through to May 4th. And then Apple, is this a discrete entity? I'm in the camp, John, where it's really not a contagion like S&L crisis in the early 1980s. There's a lot of people that agree with me on that, and we could be wrong. Is there another FRC out there? That's got to be the massive focus of the Federal Reserve System this morning.
This speaks to the conversation we've had over the last few weeks, that the events around SVB wasn't just an event, Lisa, it was a process. And it's a process we've still got to work through.
And that's why Tony Dwyer came out and said his view remains the same, that you don't see these kinds of plunges in regional bank indexes of stocks without some sort of downturn, that it is notable. You might get a near-term pop, but longer term, they're staying defensive. Good news and bad news. It's the muddle. Do you treat it as just risk off, or do you treat it as a muddle that you can buy?
You nailed it in the last hour with the idea of what does the loan dynamic do. Michael Darda of Roth MKM yesterday said this beautifully, John. The media particularly likes to do interest rate and financial market analysis. There's a point where it rolls over to a real economy balance sheet analysis. Are we there now where asset and liability dynamics maybe matter more than the parlor game of rates?
If you are just tuning in, Chris Marinak was on the program in the last hour from Jenny Montgomery Scott. This line from Chris: FRC needs to pull off the mother of all pivots to survive. He said 3 options. 1, raise capital. 2, sell assets. We think that's the direction of travel. Or 3, fail. They're the decisions right now, and I'm not sure anyone at FRC obviously wants option 3. We're going to pick up on the story throughout the hour right here on Bloomberg TV and Radio, just to get you up to speed on the price action more broadly on the S&P 500. We are positive, but only just by 0.1% on the S&P. The dollar's weaker, the euro stronger. Tom, 110.76 on that currency pair is the line of the cent to watch. That's the high of the year, 110.50 right now.
Some of the dollar dynamics there as well. John, one note as we go to Lisa, and that is the wide spread of the 3-month T-bill as compared to the 10-year T-note. As of today, hit 3 standard deviations when you look back 30 years. All you got to know, and it's a cliche, we're in uncharted territory of that high 3-month yield and that low 10-year yield.
And then the other spread we need to talk about, Bramo, right at the very front end of the T-bill curve, with the debt ceiling debate ongoing.
And I wonder how much that really factors into the longer end, this idea that you're seeing 3-month yields, the highest relative to 1-month yields, going back to the early 2000s as a result of that being the sort of D-Day for some of these debt ceiling debates and when the money really gets cut off. Today, we're focusing very much on the economic data. U.S. wholesale inventories and durable goods orders for March. This comes out at 8:30 a.m. John was mentioning the regional Fed reports that have come out softer than expected. How much do we get that confirmed in terms of business orders and how much they may be going down? Today, after the bell, Meta is the latest tech behemoth to report. Will it be the same story as Microsoft and Google? Are we going to get the same kind of strength and resilience for a completely ad-driven model, given the fact that Google showed resilience with respect to that business? Those shares are up more than 70%.
How much more can the year of efficiency deliver? We will find out. Other interesting earnings to note today. Norfolk Southern coming out in about an hour time with the overhang of what happened in East Palestine, Ohio earlier this morning. How much does this really lead to more regulation, higher expenses, a harder clampdown by the U.S. government to try to make sure this never happens again? We also get Roku and Mattel. John, a motley picture of stories that really is not giving clarity in terms of where we are in the economic cycle.
Lisa, thank you. Here's another one. This takes some of the shine off those Microsoft earnings from yesterday. This just in from the UK, this written up here at Bloomberg by Catherine Gemmell. Microsoft's $69 billion takeover of Activision Blizzard has suffered a hammer blow after Britain's antitrust watchdog vetoed the gaming industry's biggest ever deal, saying this, it would harm competition on the cloud. The Competition and Markets Authority said its concerns could not be solved by remedies such as the sale of blockbuster title Call of Duty or so-called behavioural remedies involving promises to permit rivals to offer the game on their platforms. This according to a statement that's come out just moments ago. So here's the state of play. Activision Blizzard, as you might expect, is down hard by 12%. And just taking some of the gloss, the shine, the polish of the earnings story of yesterday with Microsoft, that stock was positive, Lisa, by close to 8%. It's now positive by about 7%.
So this is where regulation and the potential of policy really becomes a really major risk. And it's not just with respect to antitrust. It's also with respect to some of these tech giants and their businesses overseas, in China, elsewhere. So to this point, it's sort of how much can this drive everything if you have that overhang and that potential risk?
I'm looking at John and Microsoft here bringing it off $2. What, John, from up 8% to up 7%. Now we'll have to watch that carefully. But, I'm still back on Call of Duty Ghosts. I mean, it was so good. I just didn't want to go forward here, and I didn't.
You don't strike me as a gamer.
Infinite Warfare.
I don't think
Either and I sit there, we're doing Call of Duty Ghosts. We're loving it. It's from like 10 years ago.
Seriously,
really,
have you ever
played it? It really still
it?
works. Call of Duty?
Yeah.
Yeah, well, the dogs like to watch it. They're like this thing. On radio, it's an ugly sight. Wait, on TV, it's an ugly sight.
Value add, TK, value add. Let me bring you some real value add if I can from Microsoft. The latest from Microsoft right now, they plan to appeal to the UK the decision to block the Activision deal. So Activision Blizzard down hard. We just move away from session highs on Microsoft in the pre-market. We'll stay on top of that for you. On the S&P 500, futures fading and fading fast. We are just about unchanged on the S&P now, Tom, with First Republic very much in focus, down almost 15, 16%.
Stealing 2 seconds from Lori Hino.
Negative.
First Republic, under $7.
Not pretty. Now trading in the sixes.
Yeah.
Lori Hino joins us now, Global Chief Investment Officer at State Street Global Advisors. Lori, once again, we're focused on a single banking name and trying to work out what it means to the broader market story, the economy, and ultimately for the Federal Reserve as well next week. How do you wake up this morning and view those things?
Well, you have to put it into perspective. I mean, clearly we're all focused on the singular name, but the bigger question is, what does this do in terms of financial conditions more broadly? As we know, regional banks are important grease in the global economy and in the U.S. economy in particular, because they originate a lot of commercial loans, they provide mortgages, they do a lot of things that actually help to propel the economy forward. So this is disturbing just through the lens of it's just tightening credit conditions, yet through another lens, even while the Fed continues to tighten.
So at this point, given the fact that we have seen some resilience from earnings of other companies, of other small regional banks, how much can we really understand the systemic restriction in lending that this is going to imply on markets in the broader economy?
Well, we think ultimately it's not systemic in terms of a major run on the banks, so to speak. I mean, you referenced earlier the S&L crisis from the 80s. We don't think it's that kind of environment, but it definitely does tighten credit conditions. And again, at a time when we're already having a variety of other things that are tightening credit conditions, including the Fed potentially raising rates again. So the real question is this an episode that passes over the next couple of months, or is it something that becomes more insidious? And part of that is going to be, what does the Fed do in May? And then more importantly, what do they signal that they're going to continue to do? Because we still have this view that the Fed has gone too far already. And if they continue to press on the brake pedal, that could create quite a stress over the summer and into the fall.
So we started the show with Max Kettner, who came on and said, everybody doesn't know what to do. It's this complete muddle. You get some positive, you get some negative, and it's actually Goldilocks. Let's go and go into risk. Why not go that route for the next couple of months at least? If we're waiting to see this, we're waiting to see that. And meanwhile, you've got companies, the bread and butter of America, delivering better than expected earnings.
Well, look, I think this is very much a trading market. And in fact, to that point, we actually went overweight U.S. equities in our most recent tactical allocation call, in part because we do see relatively resilient earnings coming through and corporate balance sheets are in pretty good shape. So this is not a story that necessarily impacts their ability to finance in the short term. But here again, the question is, how long do you ride that train? It's a momentum play right now for sure, but things that happen over the next couple of months are going to be really critical because we'll start to get indicators of whether employment is actually starting to crack in a bigger way, if we're actually starting to see credit conditions tighten to a degree which actually might derail the U.S. economy even further than we already expected to derail.
Are we getting indications of any of that right now, Laurie?
Well, we certainly are. I mean, we're seeing every day labor markets become a little bit more vulnerable. Consumer health is a little bit less than it was. We're back to pre-COVID levels in terms of savings rates and earnings power and things of that nature. Again, corporations have been quite resilient, but it's a pivot trade. It's not about just the growth in the global economy and buy commodities, buy things that are geared to growth. You have to be a lot more selective and look where there's quality, where there's relative valuation, and where there's strong cash flow.
Laurie, appreciate your insight. As always, what a busy morning again. Laurie Heinel there of State Street Global Advisors. This from Steve Englander of Standard Chartered, who sees reasons for a hawkish pause in May. Not in June, in May. Next week at the Federal Reserve, followed potentially by a hike in June, unless upcoming data confirm that a slowdown is already in place. Relative to market pricing, we see the risk return as heavily favouring an on-hold position. That's the view from Englander this morning. Here's the view right now in the market. Equity futures on the S&P totally unchanged on the S&P, with First Republic down 20% again in the pre-market. This is a session low.
That's on top of yesterday's.
It's a session low, and it follows on from that close to 50% move lower in yesterday's session. Tom, we trade right now at 640 on First Republic.
Front and center for the Bloomberg finance team, and they are looking at all the different nodes. We don't see the speculation yet of what the events this morning will be.
This started the week at the close on Monday as a $16 stock. It has been cut in half and then some, down to $6 in the pre-market. More on that with Peter Shear of Academy Securities in the next hour on Bloomberg TV, on Bloomberg Radio. Your equity market unchanged.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After months of North Korean missile tests, the U.S. will beef up the deterrence it provides South Korea against nuclear threats. In return, Seoul will pledge honor to its commitments not to build its own atomic arsenal. President Biden and South Korea's President Yoon Suk-yeol will announce the agreement today at the White House. House Speaker Kevin McCarthy is moving ahead with a vote this week on his bill linking a debt ceiling increase to spending cuts. Still, the measure is in danger of being sunk by McCarthy's fellow Republicans. GOP lawmakers from Midwestern states have raised concerns about provisions that roll back biofuel-related tax credits and subsidies. The Pentagon is learning some valuable lessons from Russia's invasion of Ukraine. According to Deputy Defense Secretary Kathleen Hicks, those lessons could come in handy in case of a conflict with China. Hicks says the U.S. needs to build a steady ammunition pipeline and continue to innovate in space. Shares of Microsoft are higher after the company posted quarterly profit and sales that were better than expected. Corporate cloud computing demand was resilient. Plus, the company gave an upbeat forecast for its growing artificial intelligence services. Microsoft will step up spending to meet customer demand for new AI tools. And the Bahamas plans to tighten crypto regulations that were tarnished by the collapse of the FTX exchange. The company was based on the island along with its fallen founder, Sam Bankman-Fried. He moved to the Bahamas as the nation sought to become a crypto hub. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
What we're doing is irresponsible, and I think it is critically important for leaders in the House and leaders in the Senate to force real spending reforms. Now, let me be clear. Under no circumstances should the United States default on our debt.
Senator Ted Cruz in conversation with the brilliant Anne-Marie Hordern and Joe Matthew yesterday on Balance of Power on Bloomberg TV. Fantastic conversation you can find on Bloomberg.com and on the Bloomberg terminal. Looking at the market right now, the equity market on the S&P 500 totally unchanged on the S&P.
Up earlier.
Was up nicely off the back of better than good numbers from Microsoft. The Nasdaq still positive for what it's worth. Microsoft still higher as well in the pre-market by 7 to 8%, even after the UK comes out to block their deal with Activision Blizzard. The name we need to watch, though, and I'll keep quoting a move for you if you're away from the screens right now. We're in the 6s. We were in the 5s on First Republic very briefly. The stock is down by more than 20%. And I'll share with you the news we've got at the moment. And it's from our team here at Bloomberg, Gillian Tan, Matthew Monks, in the last 24 hours or so, putting this one together. First Republic is exploring divesting $50 billion to $100 billion of assets in attempts, Tom, obviously, to rescue itself from the turmoil that's engulfed not just this name, but the whole of the industry over the last month or so. This, according to people familiar with the matter.
In what way? We discussed this in the last hour. In the phrase, folks, the jargon is haircut. So a bond is 100. Maybe it's trading moldy at 72. And to get somebody to be motivated to buy that, where do you price the bond? And that's the discussion that's not happening.
Well, let's make it really, really simple. Let's say I give you a mortgage and rates are at record lows. Yeah. And that mortgage, you're paying me back something like 3%. We've struck a deal. Give you lots of money, except
I'm paying out 4% right now.
Rates reset, and all of a sudden that doesn't look as attractive, TK.
Yeah.
What's interesting off the back of that story, though, when you explain it like that, it's interesting that the financial institution is facing some trouble around that, yet we haven't seen much pain in the housing market off the back of it. I think that's actually quite interesting. You look at the most recent housing data, and it looks like I saw piece after piece yesterday, economist after economist, Lisa, suggesting that maybe the housing story in this country has already bottomed out.
So there are a number of different aspects here, including cash, right? That wealthier individuals are just posting cash, so it's not about a credit story anymore on that front. But on the margins, if mortgage rates go down, and that is more closely tied to the benchmark rates of the Treasury, of the Federal Reserve, if they go down, people still need to buy homes. And that deficit of housing is sort of offsetting the tightening in credit conditions. But you raise a good point. Throw in a regional banking kerfunkel, and I almost
nice
used...
word. Whose word was that?
I'm forgetting whose word it was.
I think it was Bank of America, something like that. This is why some people are saying that this crisis is somewhat self-limiting, because ultimately rates will have to reset lower, and it will help some of the assets that are underwater. And I think this is the piece that you were talking about from Mike Dada of MKM,
right?
Who, TK, to some extent pushes back against that idea.
Well, this is dynamics, folks. It's really important to understand that this is a multi-dimensional space. We're not going to go in it now. Anne-Marie Horton's going to stand up and walk off the Washington set. But the answer is, John, yeah, you get a bond benefit, price up, yield down, bond recovery. But with that, you get a presumed slowing economy. And I mentioned earlier, if the revenue-producing talent walks out the door to competitors in, where Boston, Silicon Valley, wherever, again, it's very dynamic here, and that's what we're going to try to capture with all our guests. With FRC, a bounce off 550 up to 668 at this moment. Anne-Marie Horton is the only one in Washington not looking at FRC, and she joins us right now. What's the one-day autopsy, Anne-Marie Horton, on that 6 a.m. video yesterday?
Well, really, this was already known, right? We knew that President Biden was going to be seeking re-election to 2024. I think what everyone really is starting to talk about is a lot of the focus will be on Kamala Harris. That's really where Greg Valliere took his note this morning. And that's because she, of course, is the vice president. She is going to maintain on his ticket for 2024. But also, Biden's biggest vulnerability going into re-election is obviously these questions around his age. He is the oldest serving U.S. president at the moment. And if he was to win re-election, that would bring him to 86 years old. Jonathan and I, though, had this conversation yesterday. This is a president who takes all these trips, has a very robust schedule, and his physician says he's fit right now. Whether or not you look at it, if the election were to be today, whether it was Joe Biden versus former President Trump, the next term, both of these men will be ending it in their 80s.
Forget next year. Let's get into the meat of this morning. Here's a headline for you. AMH, I don't know if you've seen this cross just yet, so I'll share it with you.
I've seen it.
The Chinese President Xi Jinping and Ukrainian President Volodymyr Zelensky holding a phone call. Anne-Marie, frame that one for us.
Well, it's been puzzling that Xi Jinping has yet to call Zelensky since the start of the war, especially after there was this real momentum that the global community thought Xi was going to make this outreach after he went and visited Putin recently in Moscow. He has put out this fuzzy blueprint, if you will, about a peace plan that he would like to see. And yet the United States said that even if this peace plan were real, because most of it really looks like it was to the help of President Putin, he would have to be able to engage the Ukrainians, which until right now, in this moment, knowing that we know that he had the first time this call since the war began with Zelensky, he had not had this outreach to the Ukrainians. So how can you say you want to be a broker of a peace deal when you're only speaking to one side? Obviously, I would cage this with some skepticism, with the fact that obviously Xi Jinping has this, quote, no limits friendship with President Putin. And so recently we saw Chinese defense minister going to Moscow and going as far as to say Putin is a defender of world peace. But this is something that is going to draw applause from the global South, which has really been pushing for an end to this war because they are dealing with very high inflation, high food prices, high energy costs, and they want to see an end to this.
I don't have a readout of this just yet. And just to recap the news again, President Xi and the Ukrainian leader holding a phone call, this according to China State TV. AMH, I'd love to know whether this is a challenge right now to the efficacy of US diplomacy under President Biden and this White House, because it's not just around Ukraine, it's also in the Middle East, where we saw China broker some kind of conversation agreement between Saudi Arabia and Iran. How much of a challenge is this becoming?
Well, Xi Jinping is trying, and you mentioned what's going on in the Middle East, what he's trying to do at this moment. Another headline says that Xi tells President Zelensky negotiations are the only solution for war. But remember what the United States has said, that nothing about Ukraine without Ukraine. Ukraine would be the one to decide how this war ends, because for President Volodymyr Zelensky, going to the negotiating table, he does not want to give up land. And of course, there is still that question of what happens with Crimea. So all of this creates it harder for the United States, because Xi Jinping is giving some countries potentially another plan or outlet that they can sign up for. We saw that most recently with Brazil's Lula going to Beijing, criticizing the United States. And then, of course, closer to home, Emmanuel Macron going to Beijing and saying that they want strategic autonomy when it comes to how Europe views the relationship between Washington and Beijing. So I think this does make it harder for the United States, but also at the end of the day, it was China that was only able to broker the deal between Riyadh and Tehran, because obviously the United States was unable to do that. There's no communication between Iran and the United States. Xi Jinping would also be a player that could broker or help broker a deal between Russia and Ukraine, because he does have Putin's ear.
AMH, thank you. Anne-Marie, looking forward to the conversation a little bit later on Balance of Power with Joe Matthew, 5 p.m. Eastern Time. They'll be catching up with this man. This is an important one after these headlines. Richard Haas of the Council on Foreign Relations. Just a little bit more detail on this call. Xi telling Zelensky that negotiations are the only solution for war. Again, according to State TV out of China. Xi telling Zelensky that China will send a representative to Ukraine. Zelensky saying his call, Tom, with Xi was long and meaningful.
The symbolism here is extraordinary, and particularly after the Soviet Union headlines that Anne-Marie Horton mentioned of earlier this week.
The comments from the ambassador to France, the Chinese ambassador, a little bit earlier on. If you want to get up to speed with the price action, equities on the S&P 500 just about unchanged. Two names to watch. Microsoft up by more than 7%. First Republic down a little more than 20% in the pre-market. Equities on the S&P 500 just about holding on, unchanged on the S&P. After a decent gain a little bit earlier this morning, the Nasdaq's faded too, up by 0.8% after gains of more than 1% a little bit earlier. One name responsible for a big chunk of that move is Microsoft, and Bramo will run you through that name in just a moment. Outside of that, just to focus on the bond market, the two-year yield north of 4% through the whole of last week, a break at that level yesterday, and down again this morning by 7 basis points to 388 on both a 2-year and a 10-year, 338. We're negative there by a single basis point. We are on year-to-date highs, intraday highs of the year, on watch for that on the euro against the US dollar. That currency pair at the moment, 110.47, 110.76 a few Fridays ago. That's your intraday high of the year on the euro. Getting close to it. Weaker dollar story right now. Stronger euro in the mix off the back of some weaker than expected data, Lisa, through the week so far.
Yeah, and honestly, this has been really interesting to parse through the banking sector on one hand and the strength in the other. Before we get to some of the single names, Andrew Hollenhorst came out and said, yesterday we discussed why we saw little new information for the macro economy in the bank results. And he said sales of bank assets is not necessarily a macro concern. Meanwhile, fundamental economic activity data remains mixed, but markets are choosing to focus on those readings that confirm the slowdown narrative. How much is that really what we continue to see in the market?
Just getting some numbers from Boeing, reaffirming guidance. Revenue coming in at $17.92 billion. The estimate, $17.43 billion. Those numbers dropping just moments ago, Bramo. They're reporting. Meta a little bit later, onto Amazon tomorrow.
So let's take a look at what's been going on, what's been moving under the hood. We got to start with First Republic because those shares have been pummeled, cut in half, as you pointed out yesterday, down another 15%. We're really at almost a penny stock, $6.89. We can stop quoting perhaps the percentage changes. And this goes to this question, the existential angst of, does this bank survive? Do they sell $100 billion of assets? Will that be enough? PacWest showed much stronger results yesterday after the bell, reporting sort of stabilization in their deposits and then growth in April. Those shares still up more than 14%, but other regional banks suffering. And you can kind of see this on the edges, down in sympathy with First Republic America, among those down about 1.4%. You mentioned, John, Microsoft, so let's talk about it. It had been up more than 9%. Now it's up just 7.5% after Britain's regulators came out and said they were going to block the $69 billion Activision deal for Call of Duty, which I've never played, full disclosure. And you can see Activision shares down more than 10% in response. Interesting to me that Google, Alphabet, the parent company, those shares are down 1.2% after also beating earnings and giving projections that were really positive. But they didn't mention artificial AI enough, or artificial intelligence, Open AI and ChatGPT enough. And so people are a bit concerned.
Got to play the game, haven't you?
Yes.
They're not really playing the game.
Exactly.
Right now. They're basically defending their position, Tom, saying AI right now is something they continue to work on, whereas Microsoft is going through this full-scale embrace, a love affair, if you will, with artificial intelligence, with language like this. We look forward to continuing this journey on what is a generational shift in the largest software category, search. Sandy Nadella saying the right things on the call.
They're all the right touchy-feely words, but I'm sorry, it gives pause when someone with the experience of Charles Cantor of Neuberger Berman quantifies it on the income statement and says this will adjust margins. To translate that, John, and I paused yesterday when he mentioned 500 basis points, move the decimal point over 2. He's saying if somebody makes 17, they make $1, they come down, they make 32 cents, say, net margin, EBITDA, okay, we'll go there. EBITDA, they're going to add 4 or 5 percentage points because of AI. That gave me pause.
It's the journey of the week so far.
The
journey, the first step. Numbers from Microsoft and Google after the close yesterday. After the close today, on to Meta. Tomorrow, Amazon. Next week, Apple. A week from today, the Fed decision. Padraig Harvey of ING, of financial markets, weighing in on the impact of potential rate cuts. Padraig saying this: while 10-year yields have seen their peak already, it will need the imminent prospect of rate cuts to re-steepen the curves. We think cuts will come before the year ends, but the Fed is still pushing a higher-for-longer narrative, keeping re-steepening reflexes, Tom, at bay.
Very nicely done, John. Nice paragraph to pick there. He has really moved the show. It's been wonderful to have Padraig Harvey with us, head of global debt and rates at ING, with us. We've had a huge feedback, Padraig, when you're on with us. Thank you again so much for joining us today. It's moving in real time. The Federal Reserve is completely fixated on a bank out on the West Coast, First Republic, but they do have the distraction of there's a point where they shift. What's a decision tree you see that will force them to shift to rate cuts?
A recession, Tom, to be honest.
They need an NBER recession out front to move rate policy?
We're going to see a recession out front pretty soon. The labour market is beginning to move. We're seeing claims beginning to rise. We've got to remember that the unemployment rate is a lagging indicator. The odds firmly favour the US economy being in recession in the third quarter of this year. And one of the things that we're looking at here very carefully are lending standards. I mean, it's gone under the radar screen that before Silicon Valley Bank went down, lending standards were already quite tight. Lending standards have only gotten tighter. There's a very strong correlation between the tightening of lending standards relative to the performance of the economy.
So we have a two-part analysis here of are we restrictive, and then you've got other features that many others mentioned making us ever more restrictive. Can you state here, given the cards Jerome Powell's been dealt, he's super restrictive?
He is as restrictive as he needs to be here, but he needs to be restrictive, Tom. I mean, we have faced an incredible inflation challenge. And by the way, this is not a US thing alone, it's a global thing. The Federal Reserve is the global central bank, and they've got to deal with this. So they're going to pitch that funds rate up at 5.25 in May, and they'll keep it there. And the longer they keep it there, the more restrictive it's going to feel. And at a certain point, we are going to get things begin to crumble. Now, the inflation story has got to right itself as well. But we know that the Fed has got a dual mandate. They've got to look after inflation. But if the economy begins to crumble, they need to switch that focus back towards the economy, which is why by the time we get to Q4 this year, we're of the opinion that the Fed is cutting rates. That's not deviant from what's discounted in the marketplace. It's just that we're slightly more aggressive than the marketplace is in terms of rate cuts by the end of this year.
M2, can you talk to me about money supply? Is that something we should be more focused on?
M2 is through the roof and has been for quite some time. What interests me is the realness coming from M2. So let's talk about deposits. Deposits are very significant. They're currently around 18 trillion. There's been a lot of discussion about the fall off in deposits in the banking sector. I would argue that this economy, the US economy, has an excess of deposits. If you look at where loans are across this economy, there are around $12 trillion worth of loans. That difference between loans and deposits is anomalous. Why is it there? It's there because the Fed has been engaging in QE since the great financial crisis. That's the outcome of M2 and money supply. That's what you get. You get an excess of deposits in the system.
So money supply contracting, good news, a feature, not a bug of what the Fed's trying to do?
Absolutely. And also, the fall in deposits that we've seen since the middle of last year, which has been ongoing, will continue and shouldn't be an issue. It's to be expected. If the Fed is engaging in quantitative tightening, you should expect bank deposits to ease lower and trend towards where loans are printed. I mean, loans are considerably below deposits. So that's a natural process.
So how do you deal with the criticism that people might levy and say, this has been going on? As you pointed out, lending standards already were tight. And yet when we look at the earnings of some of these companies, they're stronger than expected. They're still passing along price increases. Consumers are still spending. This doesn't look like a recession.
It doesn't, Lisa. It doesn't look like a recession right now. Now, we've had a recession in tech. The banking sector has had a bit of a shot across the bows. We're looking at the real economy now. Now, I think the bit that interests me in particular, and the bit that I kind of struggle with, is if we have a recession, we're typically talking about a blue-collar recession. We're typically talking about restaurant workers getting laid off against the backdrop where currently we still have an issue getting restaurant workers. So that's the juxtaposition, and that makes the whole narrative quite difficult. But at the same time, you know, we've got to look at the full picture, and the full picture suggests that we will have pressure on the economy, increasing pressure on the economy, coming from the level of rates, coming from the tightening in lending standards over the next number of months and quarters.
So let's talk about the flip side. Are you saying that this recession will be a white-collar recession for those particular workers in areas like tech, in financials, in some of the areas that beefed up their staff during the pandemic?
So far it is, and that's how we get to a blue-collar recession. The white-collar goes into recession,
and then their end follows everything else. So then when it comes to markets, usually credit is the harbinger of what's to come. It is not flashing red. If conditions are so tight, why aren't you seeing some more concern being baked into corporate credit spreads and some of these other instruments that people look at as tea leaves?
No, absolutely. It's an excellent point, Lisa. We run various correlations between credit spreads and the economy. And if you look at the PMI numbers at the moment, they're suggesting credit spreads should be much wider. I think the answer is twofold. One, we have a huge demand for fixed income out there. I mentioned the discrepancy between loans and deposits. The residual there is going into fixed income securities. So the banking sector are big buyers of securities, and they're being forced out the credit curve. And that acts to force the entire market out the credit curve. So we've got that happening in terms of demand for securities. Anytime we've had a bit of a hiccup on the marketplace, for example, Silicon Valley Bank, primary has gone down for a few days, maybe a week, and then it's back up again. So there's big demand. That's the first point. So there's a flow argument. The second point is that I don't believe the marketplace is necessarily sold on this notion that we're heading into recession. I think there's a belief out there that we're going to soft land. So we have a different opinion. We think we will have a bit of a bumpy ride. So we're talking about, falls in output of about 0.5% to Q3, 0.5% to Q4, requiring the Fed to come in and cut rates. We're expecting delinquencies to start to creep higher. We're expecting defaults to begin to creep up. And we are expecting to see a credit spread implication, wider credit spreads in consequence.
Parag, love it. As always, Parag Garvey there of ING Financial Markets, recovering just a little bit on First Republic, very briefly trading in the 5s, back in the 7s, down 11% in the pre-market. The broader market, the S&P, just about positive on the S&P 500. Coming up next, Congressman French Hill on the debt ceiling debate. That conversation just around the corner.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Speaker Kevin McCarthy is confident his bill linking a debt ceiling increase to spending cuts will pass on the House floor this week. This despite divisions within his own Republican Party that threatened to vote against his proposal. Some don't agree with the measures, ethanol tax breaks, and work requirements for Medicaid recipients. The U.S. will gradually lift sanctions on Venezuela if the country moves toward restoring fair elections. That's according to Deputy National Security Advisor John Feiner. He spoke in Colombia, where there's a summit aimed at restarting negotiations between the Venezuelan government of Nicolás Maduro and the opposition. Shares of Google parent Alphabet are higher after the company reported first quarter results that beat estimates. Alphabet's cloud unit turned a profit for the first time. Meanwhile, its dominant search business weathered the economic downturn. The UK has delivered a huge blow to Microsoft's proposed $69 billion takeover of game maker Activision Blizzard. Antitrust regulators have vetoed the deal. That said, it could result in higher prices, fewer choices, and less innovation for gamers in the UK. And there's a sign that the Netflix's crackdown on password sharing could backfire. The streaming giant lost 1 million users in Spain for the first 3 months of the year. That's according to market research group Kantar. In February, Spain became one of Netflix's first markets to introduce a fee for users who share their login details with another household. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
A default on our debt would produce an economic and financial catastrophe. Congress must vote to raise or suspend the debt limit, and it should do so without conditions, and it should not wait until the last minute.
Oh, that's exactly what we're going to do, based on where things are right now. Janet Yellen, U.S. Treasury Secretary, on the latest
Can you
debate
imagine her breakfast
over
today?
the debt ceiling.
Table 42 at the Hay Adams Hotel. The secretary's having a breakfast there.
Who with?
You think she's looking at her cell phone?
you want to talk about our breakfast there?
No,
We'll save that for another
the
time.
The Wheaties were great.
Now we want to know.
TK complaining about the portion of berries that we received, but we can have that conversation another day. Here's the equity market, turning a little bit higher, positive 0.2% on the S&P 500. The Nasdaq with a lift as well off the back of better than good numbers from Microsoft. Microsoft in the pre-market retaining the gains of about 8% in the pre-market, even with the UK pushing back against this Activision Blizzard deal. So you've got Microsoft up by close to 8%. Outside of that, First Republic was lower by more than 20% at one point this morning, now down by 13, just about holding on to 7, Tom, in the pre-market for that bank.
A little bit of a bounce off the 6 level, even a 5 level here, and we'll see how that unfolds. What we know for certain is perhaps any president of the United States, even of the Democratic persuasion, maybe would like to talk to a banker in our legislative branch this morning. He would, of course, pick the Republican from Arkansas. French Hill, he of Delta Trust years ago in Arkansas. The banker, French Hill, joins us this morning. French, I think you more than anyone in Congress are qualified to talk about the contagion effect of what happened with these marketing exercises on the West Coast. There are 74 banks in Arkansas. How are they affected by SVB and the alphabet soup that gets you to FRC?
Well, Tom, it's good to be with you this morning. You know, in staying in touch with my bank commissioner in Arkansas and touching base with the industry there, our bankers have done well. They've been able to maintain and grow deposits. They had excellent earnings reports for the companies that are public. So the business seems solid there, and that's why I feel like the contagion and challenges that we've had since the first week of March have been connected to these banks with unusual business strategies.
Long ago and far away, William Isaac, Robert McTeer, and others had to deal with a multiple bank national crisis. What action would you like to see from the executive branch to assist the troubled bank?
You know, I think the Fed's taken quick action. I think they have the tools that they need to resolve the situations that we face right now, both in their temporary loan facilities, in their Section 13 powers that they have, and then the use of Dodd-Frank's powers in deposit insurance coverage if they feel like it's a systemic risk.
Congressman, we have to shift gears a little bit to the debt ceiling debate, which a lot of people in markets aren't as focused on, but will be probably in a couple months' time or possibly sooner. Kevin McCarthy, the leader of the House for Republicans, is trying to put together this Republican plan and push it through, getting votes to have this be the unified agreement at a time when a lot of people are pushing back in the Republican Party. Do you support this bill? Do you think it has what it needs to cross the line?
Lisa, I do. I think Kevin McCarthy has listened to his conference over the past 60 days and has created a consensus program where it meets his two standards. One, that we would not support a clean debt ceiling. We just don't have the support for that in our conference. And we wouldn't support a tax increase. And so he's crafted a plan that has savings of $4.8 trillion over 10 years and raises the debt ceiling until next year. I think it will pass. It could pass today. And I think he's done a good job listening to our conference. And what we need, Lisa, is for President Biden to answer Speaker McCarthy's call from February 1st. Let's meet and discuss this on a bipartisan basis.
Well, a lot of people would argue and push back, saying that basically this is a grab bag of Republican talking points sort of underneath the bill that Kevin McCarthy has put together. I mean, is it the right starting point? Do you feel like both sides, including the Republicans, are debating and arguing in good faith?
Well, look, the Senate Democrats, led by Chuck Schumer, can't pass a clean debt ceiling, and so it's to the House to lead by offering to increase the debt ceiling, but go back to some of the things we've been talking about now for 2 years, which is let's stop the pandemic level of spending. Let's go back to controlling spending. We propose a spending cap on discretionary spending, and we propose things that will help the economy grow, get people back to work, and save taxpayers money. I think it's a good list. I understand your point about what's in it, but I think it's a very good starting point, and it unifies Republicans to pass a debt ceiling increase.
French, we've aged on this. The late, great Pete Peterson, Paul Tsongas lost way too early, Sam Nunn of Georgia. I've heard it all before. When are we going to get our act together such as a commission that will get this done, where a commission will, like, Simpson Bowles, where we'll get a commission that will do the job Republicans and Democrats refuse to do?
Boy, Tom, it's such a good point, and I do agree with you, particularly on mandatory spending in our programs like Social Security, Medicare, the big programs that grow at 6% a year, sometimes 3 times the rate of growth in the economy. President Obama had that opportunity with Speaker Boehner, with Simpson Bowles, and no action took place. But when President Johnson started the Great Society programs and spent trillions, you had mandatory spending only as a third of the budget then, and obviously not a big interest cost. Now we have 2/3 of the budget as mandatory spending, and we're facing $10 trillion in interest only over the next 10 years. So I think a bipartisan commission to tackle up or down mandatory spending is critical, and I would support that.
Away from your remit, Olivier Blanchard does the economics and says we got lucky. We got a set of low interest rates, a low, sluggish regime where growth could stay above interest rates. I don't want to go into the economics right now, but basically he's suggesting the government had a gift handed to them that allowed for this debt extension over the last 10 years. Do you feel now that things have changed? Now the mathematics is different at the Congressional Budget Office?
I think so, Tom. I mean, you're facing interest costs that will exceed the annual expenditures on national defense in the coming year. And as I say, $10 trillion of interest over the next 10 years in the president's forecast. So we're talking about interest now truly crowding out spending priorities for Congress. I think that's a wake-up call for the Congress and a wake-up call to go back to debating how do we have zero deficits and how do we reform mandatory spending programs.
Congressman, I'm confused, and maybe because I'm a foreigner and have only lived here 7 or 8 years, so help me. I thought you had to raise the debt ceiling because of spending already approved by Congress. Is that not the case?
Oh, Jonathan, you're very good this morning. Yes, of course, you're raising the debt ceiling to cover spending that's already taken place, but it gives us an opportunity to have this two-way conversation between the executive branch and the legislative branch, and we've seen this all the time. This is why I think Joe Biden's a hypocrite on this issue, because he was the lead negotiator when he was vice president on increasing the debt ceiling with budget reforms. Nancy Pelosi in 2019 did the same thing to Donald Trump. Sorry, we can't raise a clean debt ceiling. We need budget reforms. So it's an opportunity for the two sides to have a conversation. That's why the debt ceiling vote is important.
I think I'd go one step further. It's a game that Congress seems to play that misleads the public. I'm not here to advocate to say that we should have massive deficits and that the debt should carry on piling up to 40, 50 trillion. Congressman, I just think it's disingenuous to sit here and say we've got a debt problem, but at the same time we can't raise the debt limit, because ultimately, as you know, it's Congress, which you're a part of, that's already approved this spending. It doesn't matter who's in charge of Congress, you keep approving this spending. We can at the same time, can't we say that you need to raise the debt limit, but also we need to get debt under control? Can't you say both those same things simultaneously?
Well, I think I have in this interview by answering Tom's question about a commission to get the long-term drivers of debt and deficit down. And also to your point about bringing the two parties together to work on a bipartisan basis. So I take your point technically, but politicians need deadlines. They work on deadlines, and the debt ceiling is a hard deadline, and the budget 10-year forecast can be a more amorphous deadline.
Congressman, it's a conversation we'll continue having, no doubt. French Hill.
You bet,
Thank you, sir. Thank you very much. Down in Washington, D.C., Tom, this is a conversation that's ongoing, but I think the word that you heard a few times there was politics.
It's the politics of it and the failure of these commissions, not just Simpson Bowles, but there's been others in the back. My foggy brain focused on FRC can't get there right now. But we have commissioned ourselves. I'm going to give Greenspan great credit for this, of the efficacy of commissions to get things done, and that's vapored in the culture wars and the political wars of the modern day.
Clearly, the trajectory for debt growth in this country is unsustainable. I think we all understand that. But I think that it's not explained well enough by politicians in Washington that they already agreed to this spending. They already agreed to it. That's it. The bottom line.
I think it's a good time when
this is just the political opportunity to have a big fight about it.
I think when you look at American debt dynamics, it's really comfortable to be a foreigner because you've probably got a clearer vision about it than we do.
Peter Cheer of Academy Securities, coming up next.
On our estimate, our forecast, headline inflation in the US is also going to re-accelerate towards 4.5% by the end of the year.
I think we end the year with inflation that's uncomfortably high, around 4%.
Basically, every traditional leading indicator of recessions is flashing red.
We're going to see a recession out front pretty soon.
I just think that earnings estimates are not really reflecting the fact that we're slowing down as much as we are.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Bloomberg Surveillance, earnings, yes, FRC, some price stability. John, how about talking about things away from those earnings stories and bank stories? Oil. Moments ago, global Brent crude under $80 a barrel. First time in a good number of days.
A break of 80, and all it takes is a break of 4% on a 2-year, and we're talking about recession in a bigger way in the United States. That happened yesterday. We're down another couple of basis points this morning, and then we turn things around a little bit. We're higher now by 4 or 5 basis points on a 2-year, back to about 3.93.
Flighty.
Interesting to watch this one at the moment with a 2-year Tom, back below 4% in the last 24 hours off the back of weaker Fed indicators and all of that good stuff. I'll say this, Neil Dutter of Renmac writing in again and talking about what's happening in housing. What's happening in housing is maybe signs that things are bottoming out, not getting worse. The home builders have been all over this. If you go and look at the chart of the home builders, and I'm going to use some of Neil's words himself.
Yeah.
He talks about recession. If housing is up and to the right, it's hard to talk about recession in the United States of America. And that's the pushback from the more constructive view right now on the U.S. economy.
And the more constructive view was seen yesterday, Lisa, in some earnings that were really quite good. You mentioned like Frito-Lay and the rest of it. And then there's ones that were not so good. And moments ago, Norfolk Southern out here with what on first glance looks like an earnings beat, even with all the challenges they've had in Ohio.
It's a muddle, right? You can pick your narrative in data, both with respect to a weaker than expected regional Fed data, with homes that are actually still doing okay, resiliency very much, and a recovery potentially in the home building space, definitely of note. So then how do you interpret this into a Fed call? How do you interpret this into a longer-term economic call? And do you not even try, like Max Kettner, and just say, you might as well buy while the music's still playing?
I'm going to go back to Neil Dutta's comments here, and I think we've got to give, with all the gloom of FRC and that, to both of you. John, start, please, here on the optimistic economic story out there that does not get you to a recession, or at least delays it even further.
Unemployment's still at 3.5%. It's not unusual then to have a recession after that, but that's the argument that the labour market hasn't cracked in a major way. The pushback, they'll point to jobless claims and other indicators as well. The fact that home builders are holding down, that housing indicators are recovering is somewhat encouraging. Tom, there's a massive debate out there right now, as you know.
And a polarity, and at least I'm not sure there's a gray area. I mean, there's Team A, there's Arsenal, there's Man City, and I don't think there's any. Tottenham's not in between.
It's a Rorschach test.
I can't
however you pronounce it. I always
there.
pronounce it somewhere differently. But basically, you can pick your narrative, right? And I would argue that a lot of people say all of the recession indicators that traditionally are flashing red ahead of some sort of downturn are flashing red.
There we go.
We heard that from Francis Donald. We've heard that from so many people. Porrick Garvey saying if you take a look at yield curves, if you take a look at tighter lending conditions, if you take a look at contraction in certain factory indexes, this all speaks to the same narrative.
I'm going to start the data check, John. We're going to do it off of an index, and we're going to go to an equity. It is First Republic. Let me plot it, John. 825. Plunging down to a 550 level, spiking up in moments ago with some huge volatility here at 6.90, maybe 6.50.
It's all over the place.
All over.
With a lot of doubts. Some conversation this morning, our reporting suggesting they could be looking at asset sales anywhere up to $100 billion. These are big, big numbers for this name. 690 in the pre-market, but Microsoft, the other one to watch. It's a much bigger market cap story, of course, much more important to the overall index level, much bigger weighting. Microsoft up by 8% in the pre-market, helping out this equity market more broadly on the S&P 500. On the Nasdaq, of course, much more so with a much bigger weighting there. The Nasdaq, Tom, absolutely flying, going into Meta later, Amazon tomorrow, Apple next week.
Peter Shearer, he gave the name Meta to Facebook. He's the one he called up Zuckerberg and said, I think Meta has a direct name to it. I still don't know what Meta means. Joining us now, Peter Shearer, head of Macro Strategy Academy Securities. Pull together these narratives. I mean, you and I have never seen this before. Let's start with that. But pull together the narratives that are making radio and TV listeners and viewers head spin.
I think we are on a slow bleed into the recession. It is coming. It's starting at the white collar level. I think I almost go back to the simplest thing. It's someone's expense is someone else's income. And everything I read is about people cutting expenses, which is going to hit someone's income, which is going to cause them in turn to cut their expenses. And I don't see anything switching that trajectory. I think the China reopening was a head fake. It was never really a big reopening. And to me, when OPEC Plus really cut production, they were seeing what we were already seeing. Freight was down. We're seeing shipping down. There is an economic slowdown occurring just below the surface, and it's slowly taking effect. It's going to be a grind. It's not going to be like a great financial crisis or anything. And the fact that the banks are struggling with how to keep deposits is going to hurt lending, and that's going to hurt the small business, which has been a huge driver of success in the past decade.
Much to unpack there, Pete. So let's go with China. It's a pretty emphatic thing to say. The reopening was a head fake. Why was it a head fake?
First, they were already partly open, so it wasn't like it's going from 0 to 100. They were going from 60 to 80, 70 to 90, whatever that was. But also, they are focusing more and more on their own economy, right? We already have this inventory. I hesitate to say glut, but I think we have an inventory glut. We have overbuilt. We have supply chains that have stacked up. So we don't really need China's production right now. And more, how I see this world shaping is you have China, again, we've said it before, aligning with the autocratic, resource-rich nations. And what we're seeing, we're talking about the shift from made in China to made by China. And by that, I mean China used to take U.S. products, manufacture, give them back to the U.S. companies who sold them globally. I think you're going to start to see China trying to sell Chinese products globally a little bit more and be a true competitor. I think that's going to be the scary shift of the next few years.
We can build on that later in the conversation if we have time. If the reopening in China is a head fake, what's Europe with the CAC 40 up by almost 20%, the DAX up by 17%? What would you call that?
Europe to me has become a bit of a mess. They're trying to figure out, I think, where they fit in, right? Macron's approach Xi, they're figuring out how they want to deal with Ukraine. So I'm not, but the nice part is I think some of their companies were undervalued. They're mostly big global entities. So some of that catch up, because they'd been behind, made sense. I'm kind of very neutral to bearish on Europe. I think they've got their own set of problems. On the other hand, I'm fairly bearish to neutral globally right now.
Well, that's what I was going to say. Is it really so much better in the U.S.? One of the issues that you raised was smaller banks, regional banks, and the sort of ongoing grind that we see there. We've been talking about First Republic all morning. Is this a specific story, or does it indicate something broader that is just going to grind out throughout the year?
So I think there's two things going on. One is it's really been the shift away from this concern about losing your deposits or bankruptcy to much more, what yield am I getting on those deposits, and is that yield still functional for these banks? And then I think they've also said on Wall Street, I was trying to tell my bosses this, your assets walk out the door at 5 p.m. or 6 p.m., whatever time your assets leave, it's your people. And if you start losing your people, that becomes very problematic. How do you retain those people in an environment where you're struggling?
So is that really the key issue here, that we're going to see that more broadly throughout regional banks as bigger banks try to basically parachute in, take the best talent, and then there'll just be this drip, drip, drip that will carry out and tighten credit throughout the year?
Yeah, I think it's going to make people have to come up with solutions fairly quickly, whether it's mergers, acquisitions. Again, they have some phenomenal relationships, some great business models at these places. Everyone I've talked to who ever banked with First Republic says they are phenomenal, the treatment they got. So there's value to that, and I think someone's got to capture that before those assets do walk out the door.
Let me digress. We don't need a history lesson on Milton Friedman 101. Does M2 matter? Tell us what M2 is and why people like you pay attention.
I have not been paying close attention to it lately. Again, it's been dropping off, but I think there's so many other factors.
It was all the rage 30 years ago.
It was all the rage, back when we had to figure out when Alan Greenspan was carrying his briefcase in his left or right hand. They didn't tell us what they were doing. I actually thought it was easier sometimes when the Fed wasn't trying to do this forward guidance. They've gotten themselves in so much trouble, which is why I think they had to hike last time for 25 bips when they should have already been stopping before that. So I'm watching all these things, but I do think the economy is slowing down, and it's showing up in some of the M2 declines.
Are we super restrictive right now when you add in the interest rate dynamics and the greater economy dynamics, the balance sheet dynamics? Are we beyond restrictive?
I think so. And part of this, it doesn't show up, but again, people don't have car leases coming due every year, but over a year or 2 years, 3 years, everyone's going to have to reset. Corporations did a phenomenal job during COVID issuing long-dated debt at very low interest rates, but some of that starts rolling off, and it's going to take time for the 5% rates to hit the consumer, I think we're at the early stages of that, and it only gets worse. It's not like anyone's rolling their 5% to 5% right now. We're still having people rolling 3% to 6%, and that's going to weigh on this.
So part of this conversation is about vulnerable parts of the market, and I promised you a pocket of time to come back to the point you made about the Chinese consumer and Chinese companies. Let's finish there. Who's vulnerable? Is it the Teslas of this world? Is it the LVMHs of this world? Can they really go about creating something like a luxury brand to compete with the European players? An EV operator, we know lots of names over in China. Where's the competition going to be most fierce?
I think it's going to be for everyday items. So whether it's cars, dishwashers, it's not going to be our quality, but they are going to try and sell their brands. They've taken a lot of the IP. They've got the manufacturing know-how now. It's not as good as what we produce or they produce for us, but it will be cheaper, and they will aggressively market that. One of the things that really struck me on this was they just struck a deal with Brazil where they're going to make their BYD cars in Brazil. Now, part of that's for tax reasons and stuff, but that to me is just a signal that China wants to sell their things that were really only consumed by Chinese broadly.
Amazing conversation, Pete. We could have for a long, long time. Peter Cheer there of Academy Securities. A head fake. The reopening in China, Tom, a head fake.
It's a debate. I mean, it's there. I'm going to go back to, John, I know you're going to the opening at Tiffany's here on Friday. Mr. Arnaud's in town, I think, for that big event for LVMH. And he made note to me last night. He said, God, John's covering us great. He's all over that puppy. And I saw him in Celine yesterday. And the answer here is LVMH is pushing against the sheer view. And they're saying, OK, we're on the Pacific Rim. We're going into Chengdu. That's pushing against that Chinese slowdown.
I want one thing from Arnaud. One thing.
Please.
Please just buy AC Milan. Please. There was some talk a number of years ago that he might buy the club. I mean, if you've got a struggling football club, and Milan aren't struggling right now, but if you had a struggling club, Tom, that's the man you want to buy your club.
Quantas, can we reach out to Mr. Arnaud's team just to talk to him about AC Milan?
Can they get into sport? Can they buy AC Milan?
Yeah.
Wouldn't that be phenomenal?
Yes.
It's a luxury brand. Yeah. It's in a fashion capital.
He could take that out of petty cash.
It works perfectly. He probably could. I mean, he really could. Live from New York this morning.
He brings Zava back.
Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy has bowed to the demands of a small number of House lawmakers who had threatened to sink his debt limit bill. Overnight, he decided to make changes to the measure to try to make sure it passes this week. Tax breaks for ethanol were restored, and the bill now accelerates new work requirements for Medicaid. The U.S. and the Philippines made a show of military cooperation not far from waters in the South China Sea that are claimed by China. American and Filipino forces used live rocket fire to try to sink a decommissioned vessel 12 miles off the coast. The South China Sea has been a flashpoint between the Philippines and China. Shares of Google parent Alphabet are higher after the company reported first quarter results that beat estimates. Alphabet's cloud unit turned a profit for the first time. Meanwhile, its dominant search business weathered the economic downturn. Boeing says that later this year it plans to boost production of its cash cow jet, the 737. The company reassured investors that a recently discovered manufacturing defect won't hurt its delivery and cash flow targets. Still, Boeing notched its seventh straight money-losing quarter. And the UK has delivered a huge blow to Microsoft's proposed $69 billion takeover of game maker Activision Blizzard. Antitrust regulators have vetoed that deal. That said, it could result in higher prices, fewer choices, and less innovation for gamers in the UK. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think tech outperforming, that could be forward expectations and forward easing expectations coming through. If we go back to last month, some of the best days for tech were when Fed cuts as early as June were priced in. So I think that relationship between financial conditions and tech we need to look at as well.
The absolutely brilliant Jeff Yu of BNY Mellon there on tech and the relationship with financial conditions and rates right now. Equity futures on the S&P 500 positive 0.1% on the S&P. A lift here, a small one, a bigger one on the Nasdaq off the back of some big gains elsewhere. Looking at Microsoft in the pre-market higher by more than 8 One eye elsewhere on First Republic, lower but recovering from the lows of the session. We were down by more than 20% at one point. At one point, we traded very close to 550.
Yeah.
The low 555. That was about 7:13 this morning, about an hour ago. Recovered since then to about 7:30. Tom, the opening bell 1 hour and 13 minutes away.
And after that, Meta earnings this afternoon. John, you and I will not be watching. Have you been to Etihad at Manchester
To the
City?
Etihad? No. I think nicknamed the Empty Hat.
Okay.
Because not many fans
I looked it up. You and me,
Perhaps a
two
little bit
tickets.
too harsh.
Two tickets,
How much?
$1,871 per seat.
Wow.
It's on the west side, or the west stand, I should say. Excuse me. It's very cool. It's like 5-6 rows up, down by one of the goals.
That's real money,
That's a
that
good
is.
place.
That's real money.
Is that a lot for, it's nothing for Taylor Swift.
To go and watch your average Premier League game. This is not an average Premier League game.
This is not an average Premier League.
Not at all.
The reason I'm doing that is
top two face-off.
we got major issues here this morning. We're going to go around the horn. That's baseball talk, John. Around the horn. Thank you. Because Lisa wants to talk about Google or Microsoft, and John's got another stock, and I want to talk with Meta, with Mandeep Singh, senior tech analyst with serious street cred with Bloomberg Intelligence. Meta, like $1 gazillion down to $91, total crater. Why didn't you tell me to buy it at 91, popping up to a 200 level? Has Zuckerberg saved the company?
Well, clearly they're showing a lot of cost discipline, and laying off 25% has given them that boost when it comes to the operating margin. And look, everyone knows that ad dollars have dried up. The digital ad spend has gone down. These companies, even Alphabet last night, grew 3% top line. But they are showing cost discipline, similar to Meta. And I think that's what's driving a lot of expectations.
Did Mandeep get the memo that we call Alphabet Google? And I just put up the banner. For those of you on radio, I just put up the Meta banner, and I said FB. Because that's in the real world how people think about this.
Facebook still.
What is Meta?
I'm happy to call them Meta. Do you know why I like calling them Meta? They've asked us to. But ultimately, that's what embodies the failure of this company the last 12 months. Meta. The metaverse, which is why they deserve to be called Meta. They've recovered because somehow they're going to stop spending so much money on the metaverse. Do you see the discipline around that story, the sufficient discipline to meet the mantra of the year of efficiency?
I think so. They've realized it was a bad pivot. And look, when you look at ChatGPT, clearly, this market is more established. It's organically building up. Everyone is joining that bandwagon. That didn't happen with Metaverse last year. So they made that pivot too quickly. And they're realizing they obviously spent, $10 billion on OpEx, and the user engagement never came. And they missed, with TikTok competition, clearly they were losing creators. So a lot went wrong for Meta last year. They're trying to fix a lot of that. It's mostly a cost-saving story at this point of time. But my sense is they are trying to fix their ad stack. They're doubling down on Reels, which is their video equivalent to compete with TikTok. But they're still missing that engagement because YouTube last night, they called out, their views are up 60% on Shorts, which competes with TikTok. So clearly, they have the creators, and Meta still doesn't have that organic content that they need.
How much are they relying on the U.S. banning TikTok for all their future growth?
I think that could be a big driver in terms of catalyst for top line. I think that is what they need in terms of driving the engagement back. But right now, you are in an environment where search is resilient. Social media ad pricing has come under pressure, and it will remain under pressure. And look, connected TV is the next frontier when it comes to ads, which is why YouTube is such a great asset that Alphabet has. And you're going to see them do very well over the long term.
I'm old enough to remember perhaps 3 months ago when some of these social media companies were supposedly a read on the broader economy because ad spend would reflect companies' willingness to advertise, whether they actually cared enough to spend those dollars. Has it stopped being that way, or are we still expecting some slowdown on that front?
Absolutely. I think what digital ad spending is telling you is there is a slowdown in the economy, and the software models are more resilient, which is why Microsoft grew 7% and Alphabet 3%, because software is more recurring in nature. Companies just don't get rid of their software. Digital ad spending is discretionary, but within that discretionary bucket, search is the most resilient. And Alphabet yesterday called out travel and retail being the verticals that kind of went big in terms of their ad spend.
You mentioned bandwagon. I looked up Merriam-Webster. It goes back to a phrase of 1849, which is the first time I heard the phrase nanosphere or, nanotechnology. AI. Explain to our audience why AI is not a bandwagon item.
Well, so clearly think of, what search does. It's using PageRank, and Alphabet has been successful in kind of keeping that moat because they had the best data in terms of driving that PageRank. It's not, PageRank isn't proprietary. Same thing with large language models. You're using the entire open internet to train your algorithms. Look, everyone has that, but then really you need proprietary data to differentiate your search results and, how you drive engagement. And that's where Alphabet still, to me, has the best training data for these large language models. Yes, you have to mix PageRank and large language models, which is going to have an impact on their gross margin because these are expensive from a cost infrastructure perspective. But clearly, I think your results are going to be more driven by how you can train your algorithms, for the large data set that's available on the open internet.
What I hear from you is that we're writing off Google too quickly, too much.
Absolutely. I think if they keep showing the cost discipline, we are setting up for a cyclical rebound, as has always been the case with Alphabet, because look, 60% of their revenue is still search, and that drives the bulk of their free cash flow. So still, to me, this is a great asset, where search drives it, and they continue to hold that share in search.
Any read across at all for the ad spend story yesterday from that name for the others like Meta, like Snap?
I think social media ad spend will still be under pressure because of the pricing aspect that I called out. And advertisers will go towards the highest ROI channels. That's why you heard, travel advertisers going to Google, because that's the highest ROI channel.
Mandeep, awesome. As always, Mandeep Singh there of Bloomberg Intelligence. You want shorts, Tom? YouTube, shorts? Doing those short little videos?
Yeah, I'm doing it with Chart Banner.
How's that working out?
It's an interesting experiment. We're experimenting with digital, but my answer is, and I could be wrong in this, and I think I heard it from Mandeep, YouTube is different. And I don't understand why, except anecdotally in my house, that's what everybody's looking at. That's a starting point. And the other is I got a smart guy like Mandeep telling me YouTube matters. So we're experimenting with, and you're going to roll this out this year, folks. You're going to see Bloomberg surveillance with Lisa's newsletter and a real focus on how people consume three of us on YouTube. And the shorts is sort of a teaser into that.
Well, as we know, the numbers there are pretty decent. That's for sure.
They're pretty decent, and we're evolving. We got a great team. We got Ray Schlesinger. I call him Ray YouTube. Ray YouTube's my expert on this.
Why'd you give everyone a nickname like that?
Because, Ray, Ray was there. I'm outside that bookstore where Julia Roberts fell in love with Cary Grant in London, in Notting Hill or whatever it's called. And there's Ray YouTube standing on the corner, and we're talking.
Hugh Grant. Is that who you mean? I think you do. It's a great movie. You described Notting Hill, yeah? And that was Hugh Grant.
It's not Cary Grant?
No, a different era.
Thank you.
Anyway, okay. Coming up on the Open, happy to share this with you. Bob Michael of JP Morgan Asset Management. Rick Reeder of BlackRock, Nadia Lovell of UBS, Brent Thill of Jefferies. Awesome lineup next hour on Bloomberg TV, running you through this bond market, the banking difficulties, and the success that is Microsoft in the pre-market. All of that still to come.
Bloomberg surveillance, interesting earnings this week. Mandeep Singh, Lisa, I just thought was outstanding there.
Totally agree.
Meta. Well, Meta this afternoon as well. We're watching the banking news as well. Futures up 9 right now. And, of course, most importantly, we've got to wander out here at the 8:30 hour with economic data. It is durable data. It's also ex-aircraft with Boeing reporting today. Michael McKee with us with the data. Michael, what is ex-aircraft? What does that mean?
It means you take out Boeing, basically.
You take out Boeing, right?
Because Boeing
Does France do
costs
ex-Airbus?
a lot of money to buy a jet. Here's the numbers for the durable goods orders. They are up 3.2% after a 1% decline in the prior month of February. That is rather amazing amazing beat. The forecast was for just 0.7. However, I'm going to guess a certain amount of it is Boeing. Durables ex transportation is up 0.3 after a 0.1 decline in the prior month and a 0.1 forecast, a negative 0.2 forecast. So that's got to be something to do with both cars and Boeing. Now we're getting the revisions to the prior month, and the prior month was down 1.2% for durable goods orders. Capital goods orders, non-defense ex-air, that's what Tom is talking about, down 0.4 after being down 0.7. And this is the bad news part of the report because, like we say, Boeing is worth a lot of money, but the rest of the business spending numbers aren't as good. They fall. The forecast was for just a 0.1 drop. We also see a 0.4 drop in shipments, so that's going to affect the first quarter growth levels. But it does show that companies are starting to pull back, and that obviously is going to be a question for the Fed. What does this exactly mean? Does it mean that the economy is going to slow like they want, or that it's going to collapse?
Yeah. Well, look into it further, Mike. A two-year yield moving here down 3 basis points, 393 on the yield. Let's remember that the two-year yield was about 4%. There's been a lot of other stuff going on, including the banking issues, but nevertheless, to see a 392 two-year yield gets my attention. And Lisa, curve inversion, I mean, there's a little less, there's some dynamics going on here that are interesting, to say the least.
Well, yeah, it kind of makes me feel the way that I've felt all week and frankly all year, which is there's something going on. I'm just not sure exactly what it is. I mean, that's exactly how it feels right now.
I'm going back. I mean, McKee's looking further into the data before we get to Dr. Bryson, and I'm looking at First Republic Bank to get a quote, which perfectly shows it's 6.92 on First Republic. Mike, this is March data, right?
This is March data.
Does this give you a better GDP number, seeing those difficult ex-aircraft revisions?
Well, it will give economists with their spreadsheets a little bit of adjustment. We also got wholesale inventories and retail inventories, which were wholesale comes in as expected, retail comes in significantly higher. So that would suggest an addition to growth. So at this point, I'm going to just guess off the top of my head a bit of a wash, but we'll let the people who actually do this for a living come up with some good numbers. Let me just go through this quickly and tell you that non-defense aircraft and parts were up by 78.4%. Now this is a dollar value data, and that reflects the fact that Boeing had a really good month, delivered 60 aircraft during the month, and that really matters. Motor vehicles were down 0.1. Now, motor vehicles in this report are fleet sales, but that was down, so that gives you an indication of how much Boeing matters for the rest of the durable goods report.
To go back an hour, Boeing off the price of $202 yesterday, up $6 to $208 right now. A nice 3% move up on Boeing. You heard that from Lisa earlier. With futures up 10 points, nice advance off the quiet we saw an hour ago. Jay Bryson joins us. He is chief economist at Wells Fargo. Thrilled that Dr. Bryson could join us this morning. Jay Bryson, your team, your heads must be spinning. You've got an awfully good team. What is the nuance now in your guesstimate of the American economy forward?
So let's start kind of where we are right now. I mean, these numbers are interesting, and actually we published a report this morning where we brought down our GDP forecast for the first quarter significantly, and it's based on revisions that the Commerce Department has made to back the last few months of retail sales. We think tomorrow it's only going to print 0.8%, which is significantly below the consensus. So it's not contracting at this point, and I wouldn't think, as we think going forward, you're going to see that at least in the second quarter. But as we get into the third quarter, given the Fed tightening, given what we think will be some credit tightening as well out there, I think we're still looking at a modest recession starting in the second half of this year.
As all of this data comes in and trickles in, each point different from the other, each point a miss, a beat, a miss, a beat, just basically evening itself out. Are you getting any more clarity with your conviction?
Well, no, Lisa, it changes on a day-by-day basis. I guess what I would say is, if you said, what's the probability of a recession this year in your view, I would handicap it roughly at, let's call it 70% or so. I mean, a soft landing is not out of the question, but just given the fact that things are definitely appear to be slowing out there. The manufacturing sector, I think, at best has stalled. Housing is contracting right now. Consumers are still hanging in there at this point, but higher interest rates are going to slow things down. If we see credit tightening on top of this because of what's happened in the banking sector recently, I think that all points to a recession. So, again, it's not a foregone conclusion, but I think it's the most credible case.
You talked about housing in there as one of the indicators that it was slowing down, and yet we've seen sort of a resurgence of sorts with respect to housing starts, with respect to housing sales volumes. And this morning, the MBA mortgage application number came in at a 3.7% gain. If you look at a month-over-month basis, after seeing several consecutive drops, how much are we actually seeing the rolling recession move away from industrials, move away from housing, move away from tech, and so kind of creating this real muddling inflation and muddling kind of economic growth?
Yeah, I mean, so, in terms of the housing sorts of numbers, I mean, it kind of makes sense. I mean, look what's happened to the 10-year Treasury security over the last, few weeks. That's brought mortgage rates down. And so, if you were sitting on the sidelines, that's a reason to maybe jump in right now. So, yeah, you have different sort of sectors that are kind of going in and going out. And I think that's typical for most shallow downturns. If you go back 20 years, the tech downturn, tech got hammered back during that period of time. But the housing market actually was booming 20 years ago. And so, this is not the financial crisis where everything was going down at one time, or the pandemic. Right. This is a different sectors can kind of roll in and roll out. The big thing is going to be services spending. And again, I think, we'll see that start to contract later this year.
Jay Bryson, I've got to go back to your call tomorrow of a first quarter GDP of 0.8%. Construct that across C plus I plus G plus NX. Help me here with the partition of how you get to a sub 1% American economy.
Right. So, so again, we took down our PCE, the personal consumption expenditures, consumer spending. We initially had guessed that was going to be up around 4%. Now we're looking at 2.5%, given the revisions. If you look at business fixed investment, the I part of that, we think you're going to see a negative number in terms of the, in terms of at least equipment spending there. And then there's going to probably be a big drag from inventories. We had a big inventory build in the fourth quarter of last year, right? And so I think you're looking at a 1 to 1.5% drag there as well.
Peter Lynch's team years ago at Fidelity told me that domestic final sales was their religion in terms of looking at the American economy. If you've got a 0.8% statistic with export dynamics, where is domestic final sales?
John, I don't have it here off the top of my head, but I'm going to guess we're probably somewhere 1 to maybe 1.5%.
So we don't have a recession domestic economy helped out by a good export number.
No.
Okay.
No. As a matter of fact, exports will probably be net exports will probably be a little bit of a drag in the first quarter number. Yeah.
I was completely rude there, Lisa. The reason I did that is because Jay doesn't understand this, but I need to make some news this morning. Qantas is in my ear. Will you ask him a question where we can make some news?
Well, this goes to the point that we were hearing from Peter Scheer as well, that there isn't necessarily going to be the same kind of global trajectory, a global kind of impulse as we've had in the past, starting with China and the fact that the China reopening is kind of a bust when it comes to how much they plan to import from places like the U.S. and possibly even Europe. I mean, Jay, how much are you factoring in kind of the changing global structure of trade as a reason for very slow growth and slower growth for the U.S. going forward?
So in the near term, I mean, it doesn't really have much of an effect. But we've did a series of reports on this in terms of deglobalization, if you will, and it's a modest headwind overall in global growth. Right. I mean, if things come back to the United States, which is good in kind of a long-term sort of sense, but as that transition occurs, the overall cost structure is going to go up. We're just not going to be as efficient as we were. It'd be one thing that would potentially weigh on the long-term potential potential growth rate of the U.S. economy.
Jay, be nice to Sarah House. Okay, come on. You're giving me a 0.8% statistic. Okay, I mean, Sarah's stressed out, so be careful.
Well, but she's our inflation guru. So this is more of a Tim Quinlan sort of thing in terms of the GDP sort of side of things.
Okay, Jay Bryson, thank you so much. Quinlan and House leading the charge at Wells Fargo with Dr. Bryson this morning. We've got to get back to the deterioration in First Republic. It's fractional, but nevertheless, other than two sharp spikes down, somewhat near the bottom for the day, down 15% intraday pre-market, if you will, on FRC 6.83 there as well. We've got some green on the screen. We lift back up to maybe where we were at 5:30, 6 o'clock this morning when Lisa came in. I wasn't here at that time. And the two-year yield 3.92% as well. Lisa, your observation on Gillian Tan's work, the reporting Bloomberg has on FRC.
Well, right now, First Republic is being viewed as a specific story, but with caution. And that really is the feeling that yesterday when we got that report, it brought the whole market down with it because people were thinking, oh, no, we have to think about this again.
And then it separated out.
And then it started to separate out. PacWest came out with their earnings. It calmed people down. Those shares up more than 13% in pre-market trading. Still divergences, but there isn't a feeling of complacency here or calm. There is this sense that something is happening that is going to change the creation of credit in the months to come.
Congressman Hill, a banker from Arkansas, I think was very eloquent about his faith in the institutions that were there in 1982-ish S&L crisis, overlaid on Dodd-Frank, and that those safety nets are there for the rest of the system.
Well,
to see on that.
The only problem is, and John mentioned this earlier, survive, not thrive. Are we talking about that kind of scenario where profitability is seriously challenged?
Story we'll cover through the morning with our banking team, Shonali Basak, on that story as well. Coming up, David Rubenstein at Carlyle Group. This is Bloomberg. Stay with us. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After months of North Korean missile tests, the U.S. will beef up the deterrence it provides South Korea against nuclear threats. In return, Seoul will pledge to honor its commitments to not build its own atomic arsenal. President Biden and South Korea's President Yoon Suk-yeol will announce the agreement today at the White House. House Speaker Kevin McCarthy has made changes to the debt limit bill to try to lure votes from Republican holdouts. Tax breaks for ethanol have been restored. That was a demand of Midwestern lawmakers. And now the measure will accelerate new work requirements for Medicaid. An independent team of aviation safety experts will review recent near collisions at U.S. airports. The 6 people on the panel will advise the FAA on how to improve the air traffic safety system. In January and February, there were 8 incidents involving airlines that were rated as severe by the FAA or resulted in investigations. Airbus and jet engine maker Safran warns that supply chain disruptions will continue into next year. That will complicate output just as airlines are demanding new jets. Airbus has flagged shortages on plane seats, semiconductors, raw materials, and labor. And U.S. Labor Board prosecutors accuse Starbucks of refusing to negotiate in good faith at 144 newly unionized cafes. That's according to a new filing. Starbucks hasn't responded. In the past, the company has said that it's the union that's not negotiating fairly. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
There's definitely a divergence in the action of stocks, and those big stocks that were sold off very heavily last year were reinvested in this year very heavily. So you've set these big swings in these big stocks. There are so many different actions weighing on the different sectors that it's almost like you've had a slow rolling recession in different parts of the economy since last year.
Sarah Hunt, she's Chief Market Strategist at Alpine Saxon Woods. A personal note, if I could right now. Lisa Abramowicz and Tom Keene, futures up 12. We're watching FRC as well. That seems to be clearly the story of the morning. I know they're watching that. Anne-Marie Horton making clear it is a topic of study in Washington as well. FRC in the 5 level, but back down again under 7, 6.92, down 15% today. We'll monitor that. If you go to where Lincoln died, at Ford's Theater in Washington, and you look across the street, next to where he actually died in a quiet bedroom in the back of a house, next door, there is a spectacular museum of which substantial people in this country said, we have to build this with the memories, the iconic images, if you will, the iconic America, you will, that is all of Ford's Theater. David Rubenstein providing leadership on that project across the street from Ford's Theater. He is with Carlyle Group and has a fabulous, fabulous study here of iconic America. And for the Keene family, starts strong with Fenway Park. David, you've done so much for this country in terms of our heritage. Why did a Baltimore Orioles fan start with Fenway Park?
Well, of course, Fenway Park is the oldest ballpark in Major League Baseball, built in 1912. It was made famous early in the 20th century by a player named Babe Ruth, who actually came from Baltimore. He was born in Baltimore. And most famously, he was traded from the Red Sox to the Yankees.
I did not know that.
And the result was that, yes. And then for 86 years, the Red Sox did not win a World Series.
Oh, I did not know that.
That was called the Curse of the Bambino. But the Curse of the Bambino might not be because they actually traded Babe Ruth to the Yankees. It might have been because for many years, the owner of the Red Sox refused to have African-American players on the team. So they gave a tryout to Jackie Robinson. He wasn't good enough. They gave another tryout to a guy named Willie Mays. He wasn't good enough. And so as a result, Ted Williams didn't have Willie Mays with him. Had he done so, they probably would have won World Series before. But what I tried to do in this series, there's 8 different iconic parts of America we talk about the plus and the minuses, the things that people don't know as much about the history of these iconic symbols. And that's what I was trying to do, educate people a little bit more about our history.
David, it's a wonderful series spanning all the way to the Golden Gate. And I will say, David, I did in my youth sit off the dugout on first base side and gaze at Pumpsy Green standing next to Ted Williams out in the outfield. David, I want you to talk about the American cowboy. It's not something that we can see. It's not out, I-80 across Nebraska or down into Oklahoma. Right. Tell me about the American cowboy as iconic America.
Yes, when I was growing up and you were growing up, you probably watched TV Westerns on television all the time, and it turned out that that really wasn't accurate. We called those cowboys, but actually the real cowboys were people herding cattle to train so that they go to slaughter and to be used for meat and so forth. Those cowboys, really, they're kind of people who succeed them now. There are not so many cowboys today, but there are people that do cowboy-related things in rodeos. And I went to a lot of rodeos in Cheyenne and Cody and Wyoming and also in Fort Worth to see what cowboys really do today. But the cowboys of old, they were not all white men. They were, large numbers of them were African Americans. A lot of them were Latino. We have an image that they were white men and they were shooting Indians at the time. That wasn't true. They were really herding cattle. And it was a tough life, but it was different than what we saw on television.
David, I can't keep track of all of the hats that you wear as you pervade into all spheres, which is fantastic. And what really strikes me in this article about this new series that you're doing, you were quoted as saying, I don't support any candidate anytime, anywhere. I don't give any money to politicians, no matter who they are. I've never given a penny to anybody running for president of the United States. Instead, it's to historical institutions to try to educate people on the past. Why?
Well, I am the chairman of the Kennedy Center, and I'm chairman of the National Gallery of Art and the Library of Congress Board. And I think it's more effective to do those jobs if you're not involved in politics, so I can talk to Democrats and Republicans. Mm-hmm. Secondly, I think that the way politics works today, if I'm giving large sums of money to people, which is fairly common for business people to do, you're seen as having bought something and maybe done something you shouldn't do. So rather than participate in that, I just stay out of it. I'm registered as an independent. I did work in the White House for President Carter. I'm glad I did that. but I stay out of politics.
David, I need to talk about the present business at hand, and somebody's looking for a rescue of wealth management schemes wrapped around the shroud of banking. Can big money like Carlyle, Apollo, and others, can they come to the rescue of fractured banks like First Republic?
I think the FDIC would prefer to have banks as opposed to private equity investors buy these assets, in part because banks, actually are in the business of running banks, and they can consolidate them more readily. I think there is a concern about private equity people making a quick buck or something like that, which was seen as happening the time we had the last great problem in the financial service area. With respect to First Republic, it has some real challenges, but the principal issue for a bank today is that there's a hole on the balance sheet. And with the hole on the balance sheet, somebody has to make that hole. It's either the banking organization that buys it has to say, okay, we're willing to take a loss because we'll make more profits down the road, or the federal government has to say, we'll make you whole, which was done before in 07, 08. I think right now there's a lot of political pressure not to bail out shareholders or bail out creditors, and in effect not make it possible for banks to come in and get that hole paid for by the federal government. That's the principal reason you haven't seen somebody yet buy First Republic.
Is your sense that these stories that we keep hearing about in the regional banking sector, that it's idiosyncratic, or is your sense that it is a broader issue having to do with the interest rate regime we're in?
Well, interest rates going up have not been helpful because what a lot of the regional banks did is they bought federal securities, federal treasury securities, and those are worth less if you mark to market those. Now, they're not having to mark to market, but if you do have to crystallize a sale, as was the case with Silicon Valley Bank, they had to crystallize a sale. The things that they had to sell were sold at less than people thought they were worth because interest rates have forced the value down of some of the securities these people held. So that's the problem. But right now on First Republic, I think government would like something to get done. But I think at some point somebody has to blink and say, yes, we'll make you whole for losses that you might absorb if you buy that bank. And right now there's a lot of political pressure on Capitol Hill not to do that. But I suspect in the end, something will have to get done. Otherwise, that bank will not probably be able to find a buyer.
David Rubenstein, thank you so much with Carlyle Group. And of course, putting together a series of programs, 6, 7, 8 programs out to the Golden Gate Bridge, Iconic America, tonight, 10 p.m. on PBS. 10 p.m. on PBS tonight.
What he just said there was really interesting, that basically until the government guarantees to help make people whole for losses on the balance sheet of First Republic, a deal isn't going to get done. So somebody has to blink. And Washington doesn't want to deal with the political fallout from being considered part of a bailout of what could be considered a bad actor or a flawed.
It's a really important comment, and the good news is we've only got 1 minute to talk about it, maybe a minute and a half, so I'm not going to get myself in trouble here. This goes back to a generational issue, and Ruchir Sharma and the FT 10 days ago, Rockefeller Foundation mentioned this. There's this whole new thing, the rescue culture, which Mr. Rubenstein alluded to. You know what? There's a hole in the balance sheet. Nothing else matters. You got to plug the hole. And we've got this touchy-feely modern process now where everybody's going to feel good and nobody, it's like a blue ribbon at Little League Baseball. Nobody's getting a blue ribbon for showing up in the FRC debate. Somebody's got to fix this.
Well, and then this is really the key question. Is it the government? Is there an interest by government officials
always the government.
to step
this
in?
Is Alan
but why?
Meltzer.
Right? Where is the discussion about why not let it fail? If there is distinction in the economy about good banks and bad banks, then what's the issue if it isn't systemic?
Under central banking theory, I'm going to quote Alan Meltzer 101, we have a lender of last resort knowing that the banking industry always at some point has failures. You have to have a failure process. That's what this is about.
Who are we protecting? If it isn't depositors, right? If depositors are protected,
we can't protect the fat cats. We can't. What David alluded to there, and I agree with you, it was newsmaking. What Mr. Rubenstein said is there's this whole mood that the fancy people around this bank can't be compensated for it. So it just falls away here. Right now, it's falling away. You do this to me every morning, Lisa. Like you ruin my 9 o'clock hour. 6.98 on First Republic. We'll be following that. Stay with us.